What's up, guys? It is Monday. It is first trading day of the month. It is May 3rd. Today, I think is a good indication that we sure as hell better have a good month this month. So far, the market's opening up really high, and of course, what I have here on my thumbnail and title, really the biggest item on today uh, for today is Ethereum just taking off over the weekend. It went up 10%. Hit 3,100. Didn't just hit 3,000. So hit 3,100. Right now it's trading at 3,120. Looks like the highest it got to was 30. Oh, it looks like it actually briefly hit 32 earlier this morning. So even better. I mean, it's just insane. So in the last week, no, it's actually 20. So it's about 10% in the past day and a half, 25% in the last week. Remember when it dipped, mid-April, early April? It dipped in early April to just below 2,000, and then it dipped again. It went up to 25 and dipped again to 2,100. There on April 18th, and then somewhat briefly of a dip to 2,200 on the 23rd. That wasn't that long ago, guys. That was a week and a half ago, and we're now looking at it up to 31. If you just played that dip on August to April 18th, which I did, not with tons of money, but I did play a little bit. It's up 44% since then in a matter of about 2 weeks. So again, I keep telling anyone who asks me like, what's my strategy with it? I'm putting dips on. It's no one's business. Look at February 27th. It was 1422. It's now up 119% in the past. What is that? A little over 2 months. 2 months in a week. There's not too many things out there that have been that successful in the investment market. So, yeah, I mean, a year ago, it's been $200 a year ago. In 2017, look at what happened in 2017. It went from what, $10 to about 350 really, really quickly. Um, and so this is why people are saying that we're really in the first mountain of it. We're still right here, and we haven't gotten to here yet. And then now we're here. It, everyone's wanting to cyclicize. I don't know if it's a word. The crypto market into a 4-year cycle. I get that there might be this 4-year cycle because there was a in 2013, we got in 2017, and of course 2020, 2021 is another event happening. And so, we might be in on something here, just here in 2021, and for the next 4 years. But at the same time, I mean, these cryptocurrencies have only been around for really about, Bitcoin's 2009. Ethereum started, but it probably was maybe a little after that. So it's not like these things have been around for 100 and something years, and every 4 years it's like the Olympics. It has this cycle. You can really learn from it, predict from it. Like it was, I mean, dude, I mean, ridiculously easy to predict. Uh, and the richest people in the world were all uh, making their money cyclically. Like, if you look at what we did back in 2007, it went from like if we're doing the exact same cycle, right? Then it went from what are we May 1st? What is it on May 1st in 2000? Let's say May 5th, 2007. It hit $92, which was 1,000% increase, or in 2 months, 700% increase in 2 months. And then after that, it dipped very slightly, so it went from 3 to 350 down to 229, actually, it's like 155 at one point. And then, I mean, could that have been the dip last week when it last month from 2,800 or 2,700, something like that, down to 2,100 very quickly? I don't know. And then after that, it kept kind of gradually going up for how long was that? About 6 months through, a little bit of a dip in the summertime to July, August, and then it November really took off, and then it went up from. But it's crazy to see that if you look at percentage-wise, it didn't go up that much. From November to January, it went up only 300%. But on the chart, it looks insane. And if you had held since, February of the prior year, it would be 6,300%. Basically going from $10 to $823. And then then the crypto winter sets in. It settles at 92% loss. 92. And that's guys. Hit a low of 93%. $83 back in December of 2018. So that's about a 11-month span that it dropped, and it dropped $83, and we're now only at 700% gain. So as a 3-year gap, go back here. I mean, it had some really big gains back even in 2016. It also had some big loss. But you look at 300% gain from May, May 2016 and May 2017. We're looking at a 783%. It's so, I mean, there's a lot of people that think that we're not even at the top of the curve yet, and I actually think they could be right. I know it's insane, but they really could be right. And if so, we might see one more significant dip here in the summertime. If again it follows the same cycle, one significant dip in the summertime, and then just honestly explode. And if it explodes, it might go up. It's not going to go up exponentially, maybe 800%, but it'll probably could triple in value still. And if it does, right now you got Ethereum 3,000, triples in value, go to 10,000. It's just crazy. Some of the guys that have been holding since $10. It's crazy to think that. Anyway, let's do a quick recap of the market now that it's been open for 15 minutes. Everything opened up, but unfortunately, it's been doing this a lot lately. It'll open up and it'll crash down, open way down, and it'll crash or soar up. So it looks like it's opened way up, at least the Nasdaq did, and then it's crashed down. Yeah, it's even right now. It's up, actually up 3 points, but basically it's even. The Dow, what's the Nasdaq? Sorry, the Dow is actually up from its opening. It's up 0.79%. S&P up 0.6%. So the Dow and the S&P again are going to want to flirt with records again today. Both of them are below their records slightly, but they have a good opportunity to gain. Ethereum is starting to cool off here, just down 2.5% in the last 5 hours. So we'll see if it's hitting a near-term peak. And if so, that's fine. Because Bitcoin's still quite a ways from its high of 65. And it went again, it went from 65 down to dip to 40, and is now back up to 58. So we're still quite a ways away from its high. Treasury yields dropping again, down 0.55% to 1.622. Let's go down the line here and see Apple's up slightly, which is good. Uber's up, which is great. So a lot of the reopenings, I guess, if you want to consider Uber, can both be a technical stock, growth stock as well as a reopening stock. Ford, Norwegian cruise lines. I think a lot of cruise lines are going to start to stabilize over the next couple months. It's good. Man, a lot of the other tech stocks are looking down though. Palantir, Asana, Blink, Airbnb, all of those down. ARE commercial up another 0.92%. And I'm loving that stock more and more. Should have put more into it when it was super low. Let's see some of the meme stocks. Express slightly up. What do I have here on the board? I have Amazon up there next to AMC and GameStop. Amazon looks like they're down slightly. Express is up, but just clawed its way back above 3.08. Cost is up slightly. Nokia is up. Nokia is up actually a slightly significant amount. It's actually doing well, 20% over the past month. So hopefully some things are actually going well over Nokia. Get some of that money back that I need to get back and sell out of that crap. Oh my God, man, lumber! I didn't even see it. Lumber went up to $1,500. I mean, it's currently sitting at an all-time record, $1,502. Up another 0.12%, but I mean it's just bananas. Up 14% in the last week, 46% in the last month, 69% in the last 3 months, 179% in the last 6 months. So 6 months ago it was 536, which is it was in a little bit of a dip down there in early November, but 179% from 500 to 1500, nearly tripling in price in the last 6 months. If you go back all year, it was $330 a year ago at this time, 354%, nearly 5 times as much. Go back, it's about the same, a little bit more if you go back 2 years. In 5 years, it was 269, so it's up over 5%. 10 years, 231, it's just up, what, seven times in the last 10 years. I mean, it's insane. So if you're building something, you're just toast. It is absolutely crazy. Ooh, Voyager's bouncing. Good thing. Let's see what we're looking at here. Voyager. Voyager has not done well over the past few weeks, but it's up 8% this morning. So I'll take that. I can't even remember what I bought it at, but it's up to 24, which is great. It was down to I think about 25 something. Got down to like 18 and 19 just not that long ago. Yeah, I own it at 25.45. It's at 24 right now. So yeah, my portfolio is looking really good first thing in the morning, and it's now absolutely cooled off. It's just a little rough now, so that sucks. But overall, I still think it'll be a decent day in the markets. I would like to see Nokia. I mean, I'm clawing back on my investment in Nokia. I'm in Nokia at 5.85. I would love to get that back to maybe 6 and sell it, cash that out. Pretty awesome. Here's Dillard's. Ooh, Dillard's is bouncing. Come on, Dillard's. Man, it's another one. It's not that much money, but man, I need to get Dillard's back so I can sell it and get my money back. It's not much money, but take that, 300 something dollars and put it somewhere else. Dillard's is full. It was up 5.5% so far this morning. That's awesome. Let's see what news is doing that. I mean, it hasn't got a credit line, but that's what that is. I mean, nothing crazy happened just this morning with Dillard's news. So hell, all right, guys. Well, we're going to flip it back to the markets here, or to the markets, to CNBC, and see what they have to say. We're watching here on the big board. Of course, I've got Ethereum on the top. They're the primary story today. Ethereum up here, Bitcoin on the bottom left has a little bit of a downward trend this morning, but wouldn't worry too much about that. AMC slightly down 2, GameStop down 1, Amazon. You know what I want to do here? Who do I want to put over here in the corner? I can put Dillard's. No, DDS. Dillard's. Yeah, I need Dillard to be my golden child stock today. Let's put it the 1-1. Oh man, of course, they go on to a commercial break. Look at Tesla there in the top left, down another 2% to below 700 again. I think it's a good deal there at 700. I'm still so torn on Tesla stock. I mean, now I own some Tesla stock, but it's such a tough one. It's like Bitcoin or cryptocurrency in general. Like you're just waiting for that big crash. You know it's going to happen. You're just waiting for that big crash, and you have no idea when or how it's going to happen, but it's inevitable. And, but then it never comes. And so, it being that volatile, risky play like that, similar to the cryptocurrencies, the way I like to play those, I believe in them, but I'm not going to put all my eggs in them. But I believe in them, but I'm not going to put all my eggs in those baskets. And I just play the dips. If I have cash available on the sideline, I don't put all of it in at one dip. I play the dips along the way so I don't get burned. I mean, theoretically, if I completely believe in it, I should put all my available chips in on one dip rather than playing the dips as they go up. But it's just a risk tolerance process of mine, just to play the dips in smaller increments, and I kind of treat Tesla the same way. I mean, I was thinking about putting some in when it got to $5.99 here about a month ago, and I didn't. You could argue I should have, but I decided not to at the time. But if you were watching here back then, I said, hey, now's a good time because you're getting it at a discount because of some other crap that was going on, and then. But there might be a continued lull in it because you also have they still haven't completely recovered from this accident in Houston. Was it probably 3 weeks ago? And then by them recovering the news cycle behind it, it hasn't been completely resolved. Issue is Tesla is or isn't, doesn't have some sort of a safety issue there, and then they did not have the best earnings report. It reminded me when it wasn't a fallout that everyone, couldn't look away from. So yeah, it's a tough one. Um, Sorry, trying to do something over here at the same time. So see, anyway, we got these guys back. Looks like Gap's up. A lot of clothing stores are actually up over the past maybe 3 months. But they're looking at over 2 years. This is just last year. Yeah, this is just last summer. Yeah, I mean, of course, the Gap's last summer.
In the Times today is about the idea that maybe we don't get to herd immunity because of that hesitation.
I was in with several groups, and actually many different groups this weekend, and I wore a mask and other people didn't. So I said, boy, you have great faith in the vaccine. That was my whole rap. And almost universally, they said, no, we just don't need a vaccine. Now, if we have no immunity to something, then why are we saying that there's no need for vaccine? Carl, I don't know. I found it discouraging, very discouraging. Yeah. It was in Pennsylvania, by the way.
Yeah, although we've made a lot of progress, as Dr. Gottlieb said over the weekend. Jim, another busy week of earnings. You'll kick it off tonight on Matt, of course.
Yes, well, we have a new company, GXO, which is a spinoff of XPO Logistics, and I think it's a really great company. I like Zebra. I love logistics companies. Logistics are like plastics from The Graduate. And then Sarah Greenstone's she's doing great. Lidl makes a lot of the equipment for masks worldwide, including China. But they also make auto parts. I want to find out whether that's hurting, Carl, because of, yes, the chip shortage.
Yeah. Jim, nice to have David back. We'll see you tonight, 6 p.m. Eastern Time. We're not too far from a Dow intraday high, something we've not seen since April 16th. Don't go away. Good Monday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with David Faber and Morgan Brennan. Month of May is getting off to a nice start. We're about 60 points away from a fresh all-time high on the Dow and getting some ISM numbers. Let's get to Rick Santelli. Hey, Rick.
Yes, ISM, Carl, for April is coming in on a disappointing note. We're expecting a number in the mid-60s, 60.7, 60.7. Now, of course, this goes back to January. Last time we were under 60. We're at 60.8 for February's final read. So 64.7 for March's final read. Definitely a step back. Now, if we look at prices paid, they didn't step back. They stepped forward. 89.6, 89.6. That is the highest level since June of 2008. And if we look at new orders, 64.3, also a miss, sequentially missing from 68, our last March read. And finally, unemployment, an especially important number considering it's coming out at the end of the week, 55.1, another sequential miss versus 59.6. We're awaiting construction spending, gang, and it's just hitting the wires now. Up 0.2%, a fraction of the up 1.7 we were expecting, and it follows a minus 0.8. So this is definitely another miss on construction spending. And how important is it, of course, to get the construction going? We know what housing demand is, but there's a lot of issues in construction, maybe finding people to work, not the least of which what is making it more difficult to bring people back in, considering some of the benefit issues that keep people at bay. Morgan, back to you.
Yeah, I'd imagine prices paid is in focus with that one, too. All right, Rick Santelli, thank you. We are 30 minutes into the trading session, and here are three stocks we are keeping an eye on. Starting with Verizon, selling its media assets, including AOL and Yahoo, to Apollo Global Management for $5 billion. You can see shares are up fractionally right now, about 0.5%. Plus, the court battle between Apple and Epic Games kicks off today with the future of Apple's App Store at stake, at least here in the U.S. CEO of Apple, Tim Cook, is set to testify for the first time at a trial. Shares are higher right now, though, up more than 1%. Lastly, Estee Lauder, under pressure after reporting results. Revenue coming in below forecasts. Sales of its higher-end products were impacted by people continuing to work from home. Those shares are down 5.5%. Carl, I'll tell you, lipsticks and masks also do not mix. Do not mix.
That goes for makeup generally, I would argue, Morgan. Morgan, thanks. As you know, over the weekend, Buffett and Munger reunited at Berkshire's annual shareholder meeting taking place in Los Angeles instead of Omaha. Answered 3.5 hours of questions from our own Becky Quick, who joins us this morning with some of the highlights. Becky, just a mountain of news and headlines. Morning, good to see you.
Good to see you too, Carl. You know, the Berkshire Hathaway annual shareholder meeting, as you mentioned, Carl, this meeting over the weekend generated lots of big headlines, but maybe the biggest was an inadvertent comment that came from Charlie Munger.
Well, but that's absolutely true. But I would say this, decentralization won't work unless you have the right kind of culture accompanying it.
Yeah, but we do.
Yeah, we do. But it's dependent on it.
And Greg will keep the culture.
Seems like a pretty simple comment, but it actually spoke volumes to the Berkshire faithful who have been wondering about the conglomerate succession plans for years. Fueling speculation, of course, with this comment that the top job will go to Vice Chairman Greg Abel, who runs all the non-insurance operations. Now, I spoke with Warren Buffett this weekend after the meeting and can confirm that that is the thinking of the Berkshire board today. Here's what he said. The directors are in agreement that if something were to happen to me tonight, it would be Greg who'd take over tomorrow morning. Now, if you think about that, he actually praised very handsomely both Abel and Vice Chairman Ajit Jain. Ajit Jain, of course, runs all of Berkshire's insurance operations, and both of them had been seen as being in the running for the top job because they were promoted to Vice Chairman of the company back in 2018. Buffett did say that age is a determining factor for the board at this point. Abel's 59 years old, I think, and Jain is 69. But again, just said that they would really like to see somebody who has a runway of at least 20 years running the company. But he had high praise for both of those executives. There were a lot more headlines from the meeting as well. The longest tenured vice chairman, Charlie Munger, made some headlines of his own. Munger hasn't shied away from dismissing Bitcoin in the past, and he doubled down on those sentiments.
Those who know me well are just waving the red flag of the bull. Of course, I hate the Bitcoin success. And I don't welcome a currency that's so useful and to kidnappers and extortionists and so forth, nor do I like just shuffling out a few extra billions and billions and billions of dollars to somebody who just invented a new financial product out of thin air. So I think I should say modestly that I think the whole damn development is disgusting and contrary to the interests of civilization. And I'll leave the criticism to others.
Okay, you'll leave the criticism to others. Now, when it comes to the state of the economy, Warren Buffett has a pretty unique view. Berkshire owns nearly 60 companies, from Geico and Burlington Northern to Clayton Homes and Fruit of the Loom, and also NetJets.
Very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us, and it's being accepted. I mean, it's not. If we get, well, take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs, just every day, they're going up.
Now, Buffett went on to say that it's not a price-sensitive economy right now. There is quite a bit more inflation than anyone anticipated just 6 months ago. But people at this point have money in their pockets, and he says that they will pay the higher prices. He called it almost a buying frenzy. Carl, I should point out, I know that Jim had some thoughts about what they were saying over the weekend, too. This wasn't a situation where they said they don't care about climate change and they don't think it's a problem. What they said is that they didn't want to go along with the proxy statement that was sponsored by some of the pension funds who they said buy their shares with other people's money, wanting them to fill out forms at headquarters. They went out of their way to say that Burlington Northern and Berkshire Hathaway Energy, the two of their subsidiaries that really have the most to do with carbon emissions, have been doing a lot to try and address that. Pointed out that Berkshire Hathaway Energy has retired more coal plants than any other electric company in the United States, and that they're continuing to do that and continuing to pour their money into transmission efforts that would use more solar and wind, take that power from places where the sun shines and where the wind blows and try and get it back to the major hubs of cities. And that's what you really have to do if you're serious about cutting carbon emissions. So they say that they're all in favor of that. They're spending a ton of money to make that happen. They just don't want to fill out a bunch of forms to explain to people what every one of their subsidiaries, including Dairy Queen and some of the jewelers they own, are doing to fight climate change as well.
Yeah, Becky, it's David. I appreciate your adding that, because that's a very important component of what Jim and I were discussing this morning. I think it's what they said, they're going to cut emissions as much as 60% just by 2030 overall. I did want to come back to you on succession. I mean, with two guys who are over 90 years old, you can understand why people would be focused on it. And yet, you know, you do wonder, Becky, and I mean, obviously you've forgotten more about this company than I know, but how it will be viewed once it is no longer Warren Buffett's company, regardless of the talent of whoever is appointed to be CEO. I mean, he still is the secret sauce that makes it all work, in a sense, isn't he?
You know, I think there's certainly a Buffett premium that goes along with things, and we saw this back in the financial crisis when Buffett was able to step in and do some of the deals for the banks, for GE. I think there was a Goldman Sachs deal and a GE deal. He was able to step in and do those deals quickly, and that's not necessarily something you would think a lot of other people do. You know, it'll take time. We'll see what happens with this. If you look at Greg Abel, he is somebody who's a deal maker. He's somebody who has been an operations guy who understands many of these businesses very well. And right now, all of the non-insurance operations do report through him. So he's been hands-on and deep in many of these operations. Got a decent relationship with Ajit Jain, too, who runs all the insurance businesses. But you're right. There's something to be said about working for Warren Buffett. There's something to be said about the deals that he can get done. It's hard to say what happens down the road with that, but obviously, they spent a lot of time trying to kind of mold the people who they think are best for Berkshire, people who have been there for a long time and who understand the company and the culture very well.
Becky, great stuff. Thank you for bringing us the highlights. I know there was so much that was covered over the weekend. We really appreciate it. Becky Quick.
Thanks, Morgan.
We're going to bring in our senior markets commentator, Mike Santoli, to keep the conversation going. Mike, the fact that inflation also came up in this conversation. Obviously, we've been talking about it and talking about it and talking about it. But from a market's perspective, in the midst of earnings season, given the comments we've seen from other companies, all the focus on the Fed, despite the fact that policy has shifted there and the messaging around that policy has shifted there, what's the takeaway, do you think, from a market standpoint on a day where, when usually we see sell in May, or at least historically, we're actually seeing markets rally?
Yeah, I mean, the market has been relatively comfortable with this idea that we're going to be running a high-pressure economy right now. So the combination of the huge snapback in growth, the fact that we have the pent-up savings, the fact that we, funneled all this money to households and they're spending it, and prices are going up, all those things together, we might be running at a 10% nominal GDP pace right now, if you think about the, real GDP plus whatever inflation we're going to be seeing. And for now, the markets are relatively comfortable with it. I think, one, because the main risk historically, when you did see a little bit of an uptick in inflation and inflation expectations, it immediately came with, well, the Fed's going to have to tighten. And now that's not the case, because the Fed is trying to persuade the markets that it really does have a different way of gauging inflation risk. And in fact, it's trying to stoke longer term inflation. But then it means something for which types of stocks work and don't work. And you see those with pricing power who are right there in the middle of this very intense kind of demand driven economy and supply constrained economy for goods, the UPSs of the world and everybody with pricing power and home improvement. And so I think for that reason, the economy's okay with it. And one more point, which is a lot of the scarcity and a lot of the supply constraints are in things people don't buy very frequently, whether it's homes or it's cars or it's appliances, and they often buy it with borrowed money as well as savings. So right now, we're absorbing it. It's unclear whether it means something down the road for discount rates and PE multiples and all the rest.
Mike, on earnings, again, going into the season, so far 87% are beating. That's way above the normal ratio that we see in the mid-60s. And yet, again, B of A this morning talks about negative alpha. Companies that beat are overperforming by less than usual. How much has the street had it with clear earnings beats?
Yeah, at this point, I mean, the market figured it out, even though analysts were slow in raising estimates enough. And I think we've seen this for the third quarter in a row where, the market kind of prices most of it in. Also, historically, if you look at extreme levels of earnings beats, it's not that predictive of better performance going forward. So I think that's what we have to deal with, the obvious slowdown in terms of growth rates. But forward estimates keep going up pretty strongly, and that supports the market. It keeps it from seeming that much more expensive, even though, obviously the S&P is going higher and bond yields are not going much lower. And so that should basically, help things. You really do have to have those earnings estimates keep rising.
Yeah, and of course, corporate guidance continues to be exceptionally strong, too, to your point, Mike. Thanks, Mike Santoli. As we go to break this morning, here's a look at the roadmap for the rest of the hour, including the CEO of Newell Brands talking about their latest quarter and the change in consumer habits as the economy begins to reopen.
Plus, splashdown for SpaceX, the Crew Dragon capsule landing in the Gulf of Mexico. We've got those details.
And we will have an exclusive interview with the CEO of eBay. We'll talk, of course, e-commerce trends, the company's earnings that fall in the stock price last week, and a lot more. Big show still ahead. Don't go anywhere.
Take a look at Newell Brands this morning. That's in the neighborhood of a 3-year high, roughly, as the company reports earnings where its top line up 21, earnings per share tripling year on year during the first quarter. Joining us this morning is the CEO of Newell Brands, Ravi Salagram. Ravi, welcome back. It's always good to have you.
Thank you so very much for inviting me back.
It's a fascinating look at where we are really in the broad economy, because we mentioned some of the metrics, but in general, the take is that the consumer continues to be incredibly aggressive, and it sounds like you think it's really home spending that has continued momentum.
Absolutely, Carl. The home has become the hub, and post-COVID, it is really people are spending a lot more time at home, and given that the home has become both the workplace, the place to take care of kids, to cook, to eat. So that, and we are very well positioned with the great brands we have, be it Rubbermaid or Ball or Oster and so on. So, and people for relaxation are using, and to uplift their moods after a stressful day, are using Yankee Candle for serenity and so on. And we're really seeing the amount of cooking that's going on. The number of meals, 80% of people are cooking and eating meals at home. It is the highest in the 50 years. So that gives you a sense. There's a lot more occasions, right? Breakfast and lunch, dinner, etc. So that is very, very positive, and all of that's having a great impact on our brands. And of course, the fiscal stimulus only added fillip to all of this.
Right. Now, of course, you're also exposed to some commercial categories. There's food service in there. Obviously, Sharpie and Papermate are exposed to the office culture. Where do you see that going? How consistent do you sort of see this return to office mentality expanding? Is that going to be a thing this year?
So I think the most important thing for us, we saw a writing business, which is a very important business for us. It's a very critical business with high gross margins. That we started seeing back to school in person. About 61% of school districts are in person, and about 47% of students are in person. So that is really helping our business. We saw that our writing business grew at the same rate as the company in the quarter, which was tremendous. And that is quite exciting for us. In fact, the office channel, the overall channel, for the first time grew very modestly, but grew. So now, as far as offices are concerned, that's going to be more of a hybrid for the rest of the year. And so that does have some softness. But for us, schools and universities are the biggest aspect of the writing business. But we also have other things in the writing business. Dymo, our labeling business, grew share, consumption, and sales. And so that's a big positive. So, and with the launch of Sharpie S Gel, our pen, gel pen, that has just captured America's imagination.
Yeah, Ravi, it's Morgan. I'm curious. I mean, you also said in the results last week that the second half of 2021 is difficult to predict given the global uncertainties around COVID and also evolving consumer habits, yet you upped guidance for the year after one quarter. What gave you the confidence to feel you could do that?
So thank you for that, Morgan. It's really, yes, the second half, because we are comping huge growth from last year. Second half, we were up 6%. So the question is, how will we do? But we felt with our projections that we'll actually be higher than 2019. And a lot of that has to do with the continuation of consumer trends, whether it's cooking. And then a big part of it is we believe that most of students will be back in school. We'll have a normal back to school season, and that's a big factor for us. So that's exciting. And the thing was, Morgan, all 8 businesses of ours performed well and grew. And 7 out of 8 actually grew double digits. And it was across the world, all 4 regions, across all channels. That gave us the confidence. And we're lapping a fairly poor quarter last year, second quarter. So we were able to significantly up that. We said 17 to 20% organic sales guidance. So I think that all of that contributes to a optimistic view for us that Newell's really back, and the turnaround is really, really gaining momentum.
Yeah, but do you really think people are going to be cooking as much in their homes and buying Yankee candles and as they start to return to the office and start to just go out in general?
So, look, there may be, the levels may come down a bit, but just think about, Morgan, the number of eating occasions that's increased. And this hybrid model is going to stay at least through the rest of this year. But also, I think all companies are reevaluating and providing more flexibility to their employees. So with that, we do think that there will be a remnant of this. But just think about this in terms of like ball jars. We brought a whole new set of users in who are using it not just for canning, but for a lot of other things. So interest in pantry organization, the Dream Pantry on Pinterest and other Instagram, etc., is up like 1,000%. We think some of these trends are going to stay. Plus, we're innovating quite a bit. We're putting a lot of meaningful consumer innovations. With that, we believe that we're going to be able to sustain growth as we go forward.
Ravi, you guys have a fascinating set of eyes on both office and home, and we look forward to checking in with you in quarters to come. Appreciate it very much. Thanks.
Thank you. Thank you very much indeed.
Well, coming up, we'll have an exclusive with the CEO of eBay, Jamie Iannone. We're back in 2 minutes.
Welcome back. It is now time for our ETF Spotlight. We're taking a look at the cannabis-focused ETF, ticker MJ. That is under some pressure this morning, down almost 1%, so off its highs of the session, but still up almost 50% year to date. One of its biggest holdings, Tilray, announcing it has completed its merger with rival Aphria. Tilray shares pulling back this morning, down about 3%, but the stock has still more than doubled so far this year. We got more Squawk on the Street on the other side of this break. Stay with us.
Let's get a news update on this Monday. Rahel Solomon has it. Hey, Rahel.
Carl, good morning. Here's what's happening at this hour. The situation in India is worsening, with oxygen now in short supply. Total infections are nearing 20 million after seeing a daily surge of more than 300,000 new cases for a 12th straight day. The Prime Minister's office says that they will soon build temporary hospitals and oxygen plants to try to battle the surge. And this, as fresh aid landed in India overnight, the U.S. sent $100 million worth of supplies. That included 125,000 vials of the antiviral remdesivir. It's the fourth round of help sent by the U.S., but it's also unlikely to make a dent in the country of more than 1 billion people. In Europe, the EU's executive branch has proposed easing travel restrictions for its 27 member countries. Travel in the bloc has been extremely limited, although the ramp up in vaccinations is now giving leadership hope that they can relax some of the limitations leading into the summer travel season. And domestic travel hit a fresh pandemic-era high on Sunday as more than 1.6 million Americans passed through airport security checkpoints. That is the largest total since March 12th of last year. You're now up to date. David, I'll send it back to you, but people are flying. People are out there.
Yep, I was, and the planes were crowded. Rahel?
Hope you went somewhere nice, David.
I did. No complaints. Thanks, Rahel.
Yep.
eBay reported first quarter earnings last week that beat Wall Street expectations, but it was weaker than expected guidance that sent the stock down over 10%. Joining us now in a CNBC exclusive is eBay's president and CEO, Jamie Iannone. Jamie, always good to have you. Let's just start off with that fall in the stock price, because it was notable. It was a fairly significant drop. And I mean, simply put, if I could, I guess those who were selling the stock perhaps were doing so on the belief that, you know, the GMV increase you saw, driven in part, they would argue, by the pandemic, is not durable. How do you answer that belief?
Yeah, look, you know, first it's important to recognize the quarter. We grew 38% in the quarter in revenue. We haven't grown at that level since 2005. GMV grew at 24%. And even if you look at our outlook for Q2, it has us growing $4 billion in GMV year over 2 years. So a sizable amount of growth. So we actually feel great about where the business is. It's important to take a step back and look. A year ago, the business was contracting at 2%. Now we're a $10 billion business. We've added over $2 billion in revenue over the last 12 months. Payments and advertising is allowing revenue to grow even faster than GMV. We're now a top 20 advertiser, even though our main business is in e-commerce. But I think the most important thing is that our core playbook is working, and we're expanding it to other categories. Take a category like sneakers that had been declining double digits, and now it's grown triple digits 4 quarters in a row. And so we've only just gotten started with a single-digit percentage of our GMV on this new playbook, and it makes us very optimistic for the future of eBay.
Yeah, tell me a bit more about some of those verticals that you've been creating. I guess, you know, one to come to is trading cards. You know, and again, I come back to this idea, is this ephemeral, or is this something that you believe is going to be with us for quite some time, and therefore you're going to continue to see the kind of growth you already have?
You know, collectibles is a core category, and trading cards is a key part of that. We've already done $1 billion in GMV in the first quarter, and that's more than we did in half of all of last year's record-setting levels. So we actually think collectibles will continue to be an important focus for us. If you think about the business, we've really shifted to non-new and season. It's a $500 billion total addressable market, and we're only high single-digit, low double-digit penetrated. So we have lots of opportunity for growth, not just in an area like collectibles, but in a lot of our big categories where we haven't even yet rolled out our playbook. Think motors, parts, and accessories, fashion, electronics, lots of opportunity and runway ahead for eBay.
Now, we just saw a graphic that showed your active buyer counts about 187 million globally, up 7%. There it is again. And over the last year, you added 13 million buyers. I mean, can you continue at that pace? Again, back to the overall concern of those who sold the stock, there seems to be a belief that your growth overall, both in GMV, but also in the marketplace itself, is going to slow.
Yeah, when you look at those new buyers we acquired, the 13 million new buyers, another record-setting number, what's great is that their behavior is similar to buyers before the pandemic. So they didn't just come to us for one and done and actually to buy PPE or something like that. They actually are sticking around and turning into enthusiasts. Importantly, is we're changing the customer experience all across eBay in our focus on non-new and season. So take certified refurbished. It now comes with a 2-year warranty, 30-day hassle-free returns, and eBay money-back guarantee. It's growing. We're authenticating watches. That grew at 16% last quarter, now growing at 38%. when you think about payments and the ability to have one integrated experience, we're really changing the buyer experience. And that means these cohorts are going to be really healthy for a long time.
Jamie, it's Morgan. I'm glad you just brought up payments and this changing the buyer experience. I mean, eBay has obviously been focused on scaling out this managed payments piece of the business. I mean, given the fact that you parted ways with PayPal a couple of years ago, when you look at that company or some of the others in the payments processing space, cryptocurrency is taking on more attention. It's being adopted. How are you approaching that at eBay?
Yeah, one of the great things about our managed payments is we're expanding the types of payments that we take. So we now take Apple Pay and Google Pay, more choice for buyers. We'll continue to look at other options like cryptocurrency. One of the great things about eBay is when there's a new trend, it just shows up on eBay. That's what we're seeing in areas like NFT, which we're looking at how can we explore that better, because eBay is really known as the place to transact goods. With 187 million buyers on the platform, this is the place that sellers come to get scaled demand. And we're really happy. The seller growth as well was incredibly strong in Q1. And we're really pleased with how sellers are migrating to the platform, taking their offline business and bringing it online and getting access to the world's reach through eBay.
So does that mean that you're getting into the NFT business?
We're looking at it and exploring opportunities for how we can enable it on eBay in an easy way. When you think about collectibles, everything that's really collectible has been on eBay for decades and will continue to be for the next few decades.
How long do you think it'll take you to try and understand how to actually make that work, if you make it work?
Well, there's parts that are already transacting on eBay today. People are already transacting. And so what we're all about is how do we enable and take out the friction in the experience? So everything that we're doing in our playbook is how to make eBay simpler for buyers. We're acquiring a lot of new Gen Z buyers through things like our sneakers, where they're coming on and they start buying in one category and then they start buying across the whole site.
Right. All right. Well, finally, back to sort of the macro picture. And you were asked about it on the conference call, Jamie. I mean, you talk about mobility, which in a sense means kind of return to more normalcy. And it may have impacted your ability to accurately forecast the future, which is always hard. So how are you feeling about it right now, in terms of what you see out there with mobility and stimulus, and obviously how your business benefited from things that occurred previously, and how you look at what is coming?
Yeah, look, it was an unprecedented year, but we laid out this tech-led reimagination last July, and we're 9 months into it, and we're just getting started. So category by category, what we're doing is changing the NPS and the customer experience. Buyers and sellers are following, and then GMV grows as a result. So we announced, for example, in trading cards, not only is the business strong, but we're leading in with computer vision, image-based scanning. So that'll take 3/4 of the time out of how do you list a trading card on eBay, because we'll actually figure out all that information for you. So we think there's lots of growth in an area like collectibles. We also announced customize and personalize. We're now sellers. We sell millions of these items, but we've made it a whole lot easier on the platform. Another new category. But if you think about it, we've only touched a single-digit percentage of GMV with this playbook, and we're going to expand it to all of our major categories over the coming quarters and years. That's lots of growth opportunity for eBay.
Yeah. I have an old Meg Whitman eBay trading card. I'm not kidding. I have no idea. Does that actually have value? Do ex-CEOs of eBay, does that have any value, Jamie?
Oh, absolutely. So you'll find a new, better trading experience when you try it out with our new selling experience. You'll have an easier time getting paid because we've now integrated payments. I hope you use our new advertising platform that's doing $1 billion of GMV. So you're experiencing the new eBay, and I encourage you to sell the card, and we can talk about it the next time.
All right, maybe we'll do that. Finally, you've mentioned ads a few times, obviously. People took note of Amazon's quarter, certainly. I mean, how much of an opportunity do you really see in terms of ramping up advertising as an overall % of your revenues?
It's a massive opportunity for us. If you look at it, we're only 1% of GMV through our advertising business. And so we think there's an opportunity to have, if you look at comps, kind of single to mid-digit percentages of GMV. But more importantly, the ROAS, the return on ad spend, our sellers are seeing is very, very attractive for them. So that believe there's a lot of room. We grew 58% last quarter in promoted listings, and we rolled out 3 new features. We're rolling out a cross per click opportunity that we're testing now. We're rolling out advertising for auctions, and we're rolling out off eBay advertising, where we're co-funding advertising opportunities for our sellers. So we believe there's lots of opportunity. We're already a top 20 advertiser, but we think there's lots of growth and the ability for revenue to keep outpacing GMV because of what we're doing in advertising.
Well, Jamie, appreciate the update, keeping an eye on the stock price as well. Thanks for joining us.
Thanks, David. Take care.
You too.
A Meg Whitman trading card? That feels so random. If you had
Yeah,
Pierre on
it was
Midyar,
from
maybe
their-
we would talk.
It was from their annual event. They would have these trading cards. She signed it too.
Wow,
Yeah,
autographed and
signed
everything.
eBay, Meg Whitman trading card.
All right.
Yeah, but I'm not parting with it.
Oh.
No, never.
Still to come, savings bonds for vaccines. Don't miss West Virginia Governor Jim Justice on his state's new initiative to get more people vaccinated. We're going to be right back. Stay with us.
Why investors may want to consider selling big tech in May. We'll go behind Wells Fargo's new call on tradingnation.cnbc.com. More Squawk on the Street straight ahead.
Well, it's a killer. The SPACs generally have to spend their money in 2 years, as I understand it. So they have to buy a business in 2 years. If you put a gun to my head and said you got to buy a big business in 2 years, I'd buy one, but it wouldn't be much of one.
I call it fee-driven buying. In other words, not buying because it's a good investment. They're buying it because the advisor gets a fee. And of course, the more of that you get, the sillier your civilization is getting. And to some extent, it's a moral failing too. Because the easy money made by things like SPACs and total return derivatives and so on, you push that to excess, it causes horrible problems for the civilization. And it reflects no credit on the people that are doing it and no credit on the regulators and voters that allow it. So I think we have a lot to be ashamed of in current conditions.
That's Munger and Buffett at the Berkshire meeting over the weekend, taking no prisoners on SPAC. on Bitcoin, on Robinhood. David Gabelli, I see, called it a display of intellect and energy. Although if you listen to Kramer this morning in our 9 a.m. hour, that reception was not uniform.
No, Jim was quite critical, and I do think, and I was glad Becky brought in some of the facts there in terms of climate. But Jim was critical as well of their criticism, certainly as you heard, Carl, of those who use the Robinhood platform, for example, to trade on SPACs. Listen, they'll get no argument from me in some ways, And again, investors do have the opportunity here to buy in at 10 and conceivably sell at that same price if they don't like the deal. But the incentives are not fully aligned, right? A sponsor can go out in that 2-year period and buy a business and just hope that they can get it approved, because even Morgan, if the stock price were to fall well below 10, remember the sponsors are getting roughly, let's call it 20% of the shares of the overall shares of the SPAC for free, essentially. They're paying costs, $7 million sometimes for filing and things like that. But if they can keep it above even $2.50 or $3 over a long enough period of time, they can still make money. And obviously, if it goes to if it goes to 15 or 20, it is a huge opportunity for these sponsors. Enormous. Now, of course, the other shareholders also benefit in that case. But it's below 10 where it gets a bit less clear, because certainly the sponsor still makes a lot of money, but obviously those who are buying in do not.
Yeah, and I think that's such key context that you bring to the conversation. That being said, we are starting to see the cold water be thrown on SPAC activity in general. I mean, it's not like the first quarter where we were seeing how many announcements and companies going public via SPAC a day. And that's in part because of the SEC guidance that was issued last month. Case in point, take a look at shares of Virgin Galactic. They're down about 7% right now. After that company said it's going to delay its quarterly results by about a week, that it may restate guidance from last year because of that new guidance from the SEC, from financial regulators. I'd expect we're going to see a lot more of that happening as well.
It's reclassifying in part. Yeah, it has to do as well with the PIPE investment and the warrants in terms of how they are actually accounted for, Carl. But also it has put a halt to a certain extent on PIPE investors and their willingness right now to step up. And in the last hour, of course, I mentioned as well that renegotiation of the merger terms themselves for one of these deals. So we'll continue to watch SPACs closely. As Morgan noted, of course, and we have, the actual issuance has slowed dramatically over the last few weeks.
Yeah, although obviously still crowding out some other buyers, as Buffett complained about over the weekend. Guys, one story that's definitely going to heat up today is Apple versus Epic. It hits the courtroom. The CEO, Tim Sweeney, arriving a few moments ago in Oakland. Coming up on Tech Check, Kara Swisher will break it all down. We're back in a couple of minutes.
Dragon, on behalf of NASA and the SpaceX teams, we welcome you back to planet Earth and thanks for flying SpaceX. For those of you enrolled in our frequent flyer program, you have earned 68 million miles on this voyage.
That's SpaceX Mission Control welcoming back the 4 astronauts of Crew 1 who, just before 3 a.m. Eastern Sunday morning, returned to Earth in SpaceX's Resilience capsule. Parachutes deployed for a landing in the Gulf of Mexico just off the coast of Florida. The splashdown, the first nighttime splashdown with astronauts since 1968. Marking the successful end of NASA's first ever operational crewed mission by a private company. Crew 1 had been aboard the International Space Station since November, and what is, to date, the longest ever duration for a crew launched in an American-built spacecraft. NASA's second mission, Crew 2, launched last month. It's already underway. As for the Dragon capsule Resilience, it will be reused later this year, as soon as later this year, for the first ever all-civilian trip to orbit, Inspiration 4. David.
What do you get for those miles? We know, Morgan? Anything? Can you turn them in?
Bragging rights?
Yeah, 68 million. Pretty good frequent flyer program. All right, let's get over to Dom Chu. He's got a sector sword for us. Dom.
Got to be a hotel room somewhere in the International Space Station. Now you could use those miles for something like that, David. Anyway, markets are mostly higher to start out the week. You got the materials and energy sectors leading the way higher. As you can see here, energy far and away the best performer so far today. Now, within that energy trade in particular, we're tracking some notable gains in names like Baker Hughes, also Halliburton and Valero as well. Those moves are being helped along by rising optimism over economic reopenings and demand recovery for fuels. Data from GasBuddy showed that yesterday was the highest Sunday demand for gasoline since the pandemic began. So it kind of gives you an idea that demand is returning. We'll continue to watch some of those trends as people start to hit the road for the summer travel season. So keep it right here. Energy, a big focus. There's more Squawk on the Street coming up ahead. Stay with us.
Welcome back. The governor of West Virginia is giving $100 savings bonds to residents 16 to 35 years old who get vaccinated. For more on this program, let's bring in Governor Jim Justice. Governor, thanks for being back with us.
No, thank you so much. I appreciate it.
All right, so let's talk a little bit about why you're rolling out these savings bonds, and specifically to young adults in your state. I mean, I think back to when we spoke in December, and at the time, West Virginia was leading in terms of vaccine distribution. Why the slowdown, and why do you think savings bonds specifically are going to be the thing that incentivizes people to go out and get shots in their arms?
Well, first and foremost, let me just say just this. You know, we all know West Virginia led the way. We got out of the gates really fast, and we absolutely got our people vaccinated. We absolutely saved a lot of lives, you know, with the people that are 65 years of age and older. But at some point in time, all states will hit a wall, and that's where we're at right now. We got all those vaccinated that were wanting to come, and we got out really quickly and everything. And now what we've got to do is to get across any mountain. It's always the steepest at the very top. And now what we know is we know our young people have a real reluctancy to absolutely step up because they think they're invincible. You know, from the standpoint, there is always going to be a small population of people that just say, well, I'm not taking this no matter what. But really and truly, at the end of the day, right now, the population is still out there that is saying, well, I'd take it, but it's a little inconvenient, or the population of young people from 16 to 35 years of age that think they're invincible. We've got to penetrate that. And so that's why we're doing this. And it's not a silver bullet, you know, but to give a dose of patriotism to our young people. And that's why we've tried to do it with the savings bonds. But we're trying to do something that is just novel. It's a new marketing approach and everything. It's working, but I don't think it'll be a silver bullet. You know, we'll continue to have to do anything and everything we can to where we get our people vaccinated, and we're looking to get 70% of our total population vaccinated.
How are you going to get these bonds to people? What's the distribution network going to look like?
Well, that's, you know, we're going to give them the shots, and we're going to have the addresses, and we're going to have to mail that to them. And you know, and it may very well be that we pivot, and we've got to go with a beautiful silver dollar and $100, you know, gift card or whatever. But some way, somehow, we're trying to tie it to some level of patriotism because they are really stepping up. Young people are probably not going to get real sick, but they are stepping up, and because they're tremendous transmitters of this, and by stepping up, they're going to save a lot of lives too.
Gift cards could be coming, huh? You know, I wonder what your thoughts are for the country as a whole, given you, as you said, you were ahead on getting the vaccine out to those most vulnerable. Are you concerned at some of the trends you're seeing nationwide? Because obviously it's not like people can't travel state to state as well.
Well, and this was Carl, is that correct?
No, this is David Faber.
Oh, I'm sorry, David. I'm sorry. Please forgive me. David, well, let me just say this, and you know, we should still really be concerned as a nation. I mean, if you look at what's going on all across the globe, and God forbid us to get in any situation like India, but we have a real jump start in getting our people vaccinated. But I don't know why in the world all of our people can't understand just one thing, and one thing as simple as just this. Vaccinations are saving an incredible amount of lives. And absolutely all of us stepping up, we need to do that. And so, David, you know, I am absolutely concerned. I'm concerned at the whiplash of a variant or whatever it may be. But right now, while we've got a real opportunity across this nation, we need to be stepping up because this is our duty, absolutely a duty to be vaccinated.
So where do you fall in the vaccine passport debate then? I mean, we're seeing a number of governors, particularly Republican governors, Florida, Texas, Arizona, Utah, Arkansas, I think over the weekend as well, coming out and basically banning these so-called passports. How do you see it?
Well, you know, like I said, we've got real issues globally, do we not? And from the standpoint of you know, and I'm not hearing really well, you know, when you guys are transmitting back to me, but from the standpoint of whether it be Republican or Democrat governors and everything, you know, one thing we absolutely need to know is just that if we want to go back to normalcy and be able to open up and get rid of these masks and get rid of all this stuff, which I want to do more than anything in the world. But if we want to get there, our ticket is one thing, and that bridge to a vaccine. We've got a vaccine right now. We need to be on it.
All right. Governor Jim Justice, thanks for joining us today. Good luck.
Yeah, thank you guys so much. Thank you now.
All right, David, just taking a look at the markets for this first trading day of May before we wrap it up here. I mean, it's largely green. Although we're coming off of the highs of the morning, the S&P 4198 is the level there. The Nasdaq, though, turning negative just a short while ago.
Although we have had a nice run, of course.
Yes.
Yeah, taking a look at some of those earnings from last week, of course, Apple shares barely up. Amazon, which did not perform particularly well, given what many said was a blowout quarter and an expectation perhaps that while that will continue, is down yet again, Morgan. So your point on obviously NASDAQ is an important one at this point, down 0.13, so not a huge decline, although still trailing the overall broader market with only an 8% gain so far this year as the comp.
It's another busy week of earnings, about 25% of the S&P reporting. We've also got that key jobs report on Friday, so it's going to keep us busy. That's going to do it for Squawk on the Street today, though. Tech Check starts right now.
Good Monday morning and welcome to Tech Check. I'm Deirdre Boza with Carl Quintanilla and Julia Borston. John has the morning off. Today, Epic faces off with Apple in the courtroom. How this case could change Apple and the way that we use our smartphones forever. Then, Buffett talks Bitcoin, Robinhood, and the gamification of investing. It is the old guard versus the new. We'll explain that in a moment. And later on, Kathy Woods is a Twitter over Twitter, a breakdown of ARK's defense of the stock this hour. Julia?
Well, stocks are higher as the Dow flirts with a 300-point gain. NASDAQ, the laggard of the three, actually turning negative just moments ago with names like Skyworks, AMD, and Tesla all dragging down the tech sector. Carl?
Guys, at the top of our feed today, and maybe all this month, is going to be this epic showdown in the courtroom as Fortnite creator Epic Games squares off with Apple over whether the App Store is an abuse of monopoly power. Right now, Apple takes about a 30% cut of all in-app purchases made on the App Store. That's a big part of the Apple story on Wall Street, of course, is the service revenue. Epic has countered this by removing its immensely popular Fortnite from the store. Tim Cook will testify, as well as Apple Games Tim Sweeney, Epic Games CEO Tim Sweeney today. An interesting figure in his own right, Julia.
Absolutely. Well, after opening arguments this morning, Epic CEO Tim Sweeney will take the stand today to explain why his video game maker is suing after Apple kicked Epic's games out of the App Store for trying to circumvent its fees. Epic protesting the 30% fee that Apple takes from in-app purchases in its as well as other games. And Epic is hoping, and Tim Sweeney are hoping, this trial could permanently change Apple's model. Epic argues that the App Store is a monopoly, that the payment system is anti-competitive, and that Apple's 30% tax passes costs onto consumers. And Epic argues the fee should be closer to 12%. That's what Epic charges developers in its own store. Now, at the center of this battle is hit game Fortnite. It grew to 350 million players as of May 2020, and Epic paid an estimated $210 million of its $700 million worth of 2 years of iOS revenue to Apple, though it's worth noting that Apple represents just 7% of Epic's revenue, according to court documents. Now, behind this battle is billionaire Epic founder Tim Sweeney. He sold 40% of his company to Chinese giant Tencent, but he does remain Epic's largest shareholder. He just arrived at the courthouse moments ago. Last night, Sweeney tweeted, quote, Epic is a company built on the aspiration of serving a new generation of developers and customers as openly and supportively as Apple did in the era in which they invented personal computers. As we go into court, it is for those original digital freedoms that we will fight. Guys, the trial gets underway in just a couple of minutes. It's going to be so interesting to see how this plays out, Carl. But Tim Sweeney wants to be out there as a freedom fighter, right?
Yes, that certainly he's got a lot of people championing him and rooting him on, although it's going to be interesting to see Apple's response to both this, Dee, as well as the news we got out of the EU on Friday regarding Spotify's complaint about competition. It'll be interesting to see how many fronts Apple can add to this war and effectively fight.
Yeah, those fronts are building. And Julie, it's interesting that, Epic talks about the 12% that they charge developers in their own store. But key question here is, what is the market? Are we looking at iOS or are we looking across gaming platforms, right? Because other gaming consoles, Microsoft, Nintendo, they charge a similar commission fee to Apple, around 30%. This is what Apple is going to argue, that, as you mentioned too, they are a relatively small part of Fortnite revenue. So if you're talking antitrust, you have to look across a number of platforms, and Epic can choose who they do business with.
Yeah, absolutely. I mean, look, Apple has a very good point. The fact that that 30% fee is standard. It's exactly what Google charges, and Epic is also suing Google for the same issue. But, Apple does have the consistency on its side here, the fact that it has done so much to enable so many different small business developers to bring their apps to the world. So it's going to be fascinating to see how this plays out. And I'm going to just be watching every minute of it, Deirdre.
Yeah, it's exciting to see them all walk into the courtroom live this morning. We'll keep track of that. And speaking of Apple as an investment, Carl mentioned that they're fighting battles on a number of fronts. Berkshire Hathaway CEO Warren Buffett, though, talking the stock over the weekend at Berkshire's annual meeting. Here's what he said on his Apple strategy and Tim Cook's management.
We got a chance to buy it, and I sold some stock last year, although our shareholders still had their percentage interest go up because we repurchased shares. But that was probably a mistake. In fact, Charlie, in his usual low-key way, let me know that you thought it was a mistake too, didn't you, Charlie?
Yes.
Yeah. I could only do so many things that I could get away with Charlie, and I kind of used them up between Costco and Apple. Incidentally, he probably, he very likely was right in both circumstances. It's an extraordinary business. But I do want to emphasize that in his own way, it's a different way, but Tim Cook is, we see a lot of managers of a lot of businesses, and you're looking at two great ones on both ends here. He's handled that business so well.
Talking Tim Cook as an extraordinary CEO, an extraordinary business, but let's see what this lawsuit does to the Apple and Cook reputation. And let's bring in Kara Swisher for more. Recode co-founder, New York Times columnist, and a CNBC contributor. Kara, good morning. Outside of Buffett, it does seem like everyone's taking on Apple, Spotify, Facebook, of course, Epic. This is called our fight card. How long can Apple continue to fight with these major partners before it becomes a distraction to that extraordinary business that Buffett talks about?
As long as it takes, I guess. I don't think it's that much of a distraction. Look at the results that they just turned in, which were extraordinary. I mean, what's interesting, and I think Buffett is right. He's an extraordinary manager. He really is, bringing this value of this company from $300 billion to $2 trillion. And obviously, they're killing it again in this quarter. I think there's a problem here. Everybody can be right at the same time in this case, and everybody can be wrong. I think that Apple is vulnerable, not with Facebook. I mean, I just ignore that completely. In many ways, but I think they have to sort of face the music on these fees. Even though they may not be the home market, they are one of the dominant players in the market. They're also right about trust and safety of their app store. So I think it'll be interesting to see how they play it here in the case, and what Epic tries to do. I don't particularly like Tim Sweeney's "I am here for the little guy" stuff. He's there for Epic Games. And that's what he's doing. And so I think when anybody embraces the way Facebook embraces small business, or Tim embraces all the other developers he's fighting for, it's really about their business and whether they can come to terms. And that's how I look at it. It's a business deal. And Apple will either win or lose in this case. And then in that case, we'll probably negotiate some fee that is probably lower over time, would be my guess.
That's what I was going to get to. What's actionable out of it, depending on how the decision goes, Kara? And I wonder if they did give a cut on the fee, how do you think the street might read that?
I don't know. I think it might grow it, right? It could grow it if they move forward. They've done it a little bit. They've shown a little bit of, flexibility. I suspect they will probably be more flexible in the end. I think it's a growing problem, especially if they have to deal in Europe with regulatory issues. I think the bigger problem is these other businesses they have that compete with things like Spotify or podcasts or things like that. That's where they're vulnerable the way Amazon is in the same way. They have a marketplace and then they have products. And so that's something that's pretty relatively clear. In this case, they say that we're running a store. You can go to other stores if you want, and we'll see if people believe there are other stores worth going to. And I think that's going to be the big issue here. I'm not sure. I think developers are unhappy, and yet they also depend on Apple. And if Apple is doing its job, it should be making developers happy as well as consumers.
And Kara, developers certainly depend on Apple to reach all of its users. I guess the question is, if you assume that Apple's going to make some sort of compromise with Epic, are you surprised that they didn't settle before the trial started today?
Not so much. Not so much. I think they don't, look, Tim Cook sort of sticks to his guns on a lot of stuff, I would say. I actually shouldn't be using that expression anymore. He's very consistent in terms of putting out the company line on certain things. But it's also Epic's issue, right? They really do want to fight this. They do want to litigate this because they want to get the upper hand in this case. It's not, the issue is it's not that big a part of their business, but it is an important part of their business. And so I think they want to make a stand here. I can't imagine what the negotiation would be. I don't think Apple will go down to 12%. So there's some number in the middle, or maybe a little higher, that they're going to end up settling at, and we'll see where it goes. It's definitely these issues of who has power and over the consumer is a really important ones going forward. Whether it's Facebook, whether it's Apple, whether it's Amazon, whether it's Google, and they have to face the music in terms of how they're going to negotiate with people who are in their ecosystem. And so this kind of was inevitable. It's probably fine that it's a course case. The ones in Europe are problematic for them because that's Spotify. And again, they're also competing with Spotify in the podcast segment too, because Spotify has been super aggressive in that area. And so I don't worry about them fighting on multiple fronts because it's the same issue in each of these cases. And again, leaving Facebook out of it, which is a very different story.
So you're setting Facebook aside, but you think that it's not going to be a distraction to have all of these different balls in the air. You don't think there's any risk and we saw great results in the most recent quarter, but you don't think there's any risk going forward that Apple get distracted the way, say, Microsoft did? No. Not unless there is some major court case, in the United States, an antitrust case, maybe. But, they're facing issues. They've got plenty of money for lawyers. They've got plenty of bandwidth in their legal team and other areas. No, I don't think so. I think they're moving ahead on AR. They're moving ahead on their car. They're moving ahead in lots of it in healthcare. So, no, I don't.
Kara, but with Microsoft, it was sort of that competitive intensity that changed. So you don't see that happening. I mean, Apple, relative to the other tech giants, hasn't been that acquisitive, but you think that's less of a risk too?
Bill Gates is a very different person back then than Tim Cook is today. I think he can handle it. He's not as emotional, Tim Cook, in terms of how he makes these decisions. So, that was a very emotional time. I'm super old, so I remember it. But that was a very different time in tech, and they sort of saw themselves as these sort of pirates taking over things. And so I think he's making a very calculated business decision here, and I don't think Tim Cook does anything without thinking super hard about what he's doing. They're not doing a whole lot of Facebook is saying we're here for small businesses, and Epic is going we're here for developers. You don't hear a lot of that out of it. They just say, you know what I mean? He doesn't bite. Tim Cook doesn't bite when those things happen, and he's smart to do so. I think they have a problem with their marketplace, though. I do. I think, competing in the music space with Spotify there, that is something that's much more significant in my estimation. In this case, it's a negotiation, and they're just doing it in court. So we'll see where it goes.
Yeah. Yeah, we're going to see how that second front develops over time. Finally, Kara, these Verizon assets going to Apollo. Our viewers, I'm sure they must know that you built your career on your AOL coverage back in the day. What do you say at this point?
What did I call this at the time? A disaster waiting to happen. I mean, it was literally like watching when I was covering it and kept saying, I can't even tell you how many times I got calls from Verizon, AOL, and Yahoo executives about how mean I was about thinking this was the stupidest thing ever. So I don't like, I told you so, but this was a ridiculous acquisition at the time. It was overpriced. It's just fine. It's selling for exactly what it should sell for, and it's ending the way it should have. Verizon has other things to do, and this is a total distraction in an area they have no expertise in. And as much as I like Tim Armstrong, I really think him putting this together was a mistake many years ago, and I still think it was a mistake now. So.
Kara, you always give it to us straight. Thank you, as always, for your insights.
What do you think, Carl?
This is why we love you.
Anyway, whatever.
Okay, we'll talk to you soon, Kara. Thank you.
All right.
Bitcoin and the growth of the Robinhood trader both came up at Berkshire's meeting over the weekend, and both Warren Buffett and Charlie Munger made critical comments. Here's Charlie Munger.
Well, that is really waving the red flag at the bull. I think it's just god-awful that something like that would draw investment from civilized men and decent citizens. It's deeply wrong.
The old guard versus the new. Kate Rooney, you could, as many have, argue that those comments missed the mark in terms of that technological innovation that crypto and blockchain offer, the ability to democratize or decentralize finance that we've talked a lot about here. Also, those comments on the retail or Robinhood investor at large, drawing some very strong responses.
That's right, Deirdre. That's certainly what Robinhood is arguing today. Let's start with Berkshire Hathaway CEO Warren Buffett, though. He said that Robinhood is essentially promoting casino-like behavior in the stock market. This was at Berkshire's annual meeting on Saturday. Here's what he had to say.
I do want to see how they handle the source of income when they say they don't charge the customer anything. I mean, it'll just be interesting to watch how they describe it. I mean, but they have attracted, maybe set out to attract, but they have attracted. I think I read where 12 or 13% of their casino participants were dealing in puts and calls. I looked up on Apple, the number of 7-day calls and 14-day calls outstanding, and I'm sure a lot of that is coming through Robinhood. That's a bunch of people writing. They're gambling on the price of Apple over the next 7 days or 14 days. There's nothing, there's nothing illegal about it. There's nothing immoral, but I don't think you'd build a society around people doing it.
And Deirdre, you mentioned the old versus new. Robinhood really homing in on that with a fiery response this morning, arguing that, quote, there is an old guard that doesn't want average Americans to have a seat at the Wall Street table, so they will resort to insults. The future, they say, is diverse, more educated, and propelled by engaging technologies that have the power to equalize. Adversaries of this future and change are usually those who've enjoyed plentiful privileges in the past and who don't want these privileges disrupted. Their criticisms, they say, are unfortunate, but they prove why Robinhood's mission is, in fact, critical. The new generation of investors, they say, aren't a casino group. They're tearing down old barriers to investing, taking control of their financial futures. And they finally say that Robinhood is on the right side of history. And guys, a big part of that criticism, you heard Warren Buffett say it, is payment for order flow, essentially getting paid for customer trades, or sending that order flow to high-frequency traders. Robinhood, over the weekend, right before Buffett and Munger essentially made those comments, Robinhood put out their SEC disclosures for payment for order flow. That showed about $330 million in the first quarter. that almost tripled from the year earlier. So some big numbers there showing that whatever this is, casino or not, it is proving to be pretty profitable for Robinhood. Back to you.
What a
pretty
showdown
profitable for
developing
Robinhood, but
between the Berkshire guys.
Yeah,
Go ahead,
quite
Julia.
a showdown. And I'm just wondering, Kate, if it really seems like this division here and this battle is over what's happening right now, or about Munger and Buffett's perception of sort of what happened with GameStop, or the way that Bitcoin used to be used primarily for illegal transactions, and now you could use Bitcoin to buy a Tesla. Do you think it's about and this is being put forward by the Robinhood folks, that maybe Buffett and Munger just aren't up on the latest of what they're doing, what they're offering, and the democratization they're offering their clients?
That's right. Robinhood has made a couple of changes even since the GameStop thing. They took out confetti, for example, which has been a big part of the gamification criticism. But their argument would be that they are meeting investors where they are and sort of how they want to invest. If you think about this generation of younger mobile-first iPhone users, they say that is how they're interacting with everything, whether it's investing or, buying a house. So that would be really the new guard argument. Obviously, Munger and Warren Buffett have been around for multiple cycles. They've seen this end badly. And I think the big fear here for a lot of people is that a lot of folks who are drawn into investing right now, because it is so easy, it might be too easy. They might end up being the ones sort of holding the bag here.
We will find out when cycles change, Kate. Great setup, by the way. And it brings us to our crowdsource today. What do you think of the comments out of Buffett and Munger regarding Robinhood and Bitcoin, too? Tweet us at CNBC Tech Check. You can hashtag crowdsource and let us know what you think. We'll show off some of the best comments, Julia, later in the hour.
And still ahead this hour, more from Warren Buffett. Kathy Wood defends Twitter and a foldable iPhone. Tech Check is just getting started.
Stocks are higher today. Dow within a stone's throw of an all-time high, coming off that week of blowout earnings results from tech, mega cap tech last week. We saw some major growth in FANG earnings, as you know. Guidance was good. Got some differences in stock prices. Take a look at Alphabet and Netflix, a 40% divergence in their performance year to date. What is the setup now in terms of valuation? Let's bring in Dom Chu for a look at that story. Dom, I think it was Tom Lee who said that you could safely call April a bit of a face ripper.
It was a bit of a face ripper in so many ways on the trading dynamic, but what it has done over the course of the past couple of weeks, Carl, is made attractive valuations, at least relative to where they were about a week or two ago. So here's what I'm going to show you first of all. This is the forward price to earnings ratio of the technology and communication services sectors. This is kind of over the longer term, but I want to kind of focus in on just right here in the last couple of weeks or so. You've seen a pullback in valuations a lot because, yes, there's been a modest pullback in some of those stock prices from record highs, but also because we've seen earnings expectations start to rise a little bit for the coming year. Remember, forward price to earnings looks at the earnings, again, for the next forward-looking year. So again, analyst estimates are a piece of the pie there. Now, you've seen them come about a point better for both of these sectors. Now, let's take a look at the three companies that really, really matter in terms of what drives these earnings reports and whatnot. First of all, Microsoft, the second biggest company in the S&P 500, is now, again, trading at 33 times, at least I can say 33 times next year's anticipated earnings about a week or so ago. And now it's come back to around 31 times. So you can see a pullback there in the stock. Valuation is also attractive. Apple, by the way, let's show you that one as well because it's the biggest contributor to the S&P 500 and NASDAQ. It's now at about a 26 times forward valuation. It was about a week ago around 29 times. So again, the valuation's becoming a little bit more attractive on a relative basis, and we'll end on one that's a little bit more steep than others in terms of pullback. Alphabet, the parent company of Google, is now currently trading at 27 times next year's anticipated earnings. It was about a week or so ago closer to 31 times. So again, Carl, again, a pullback in some of those shares, very modestly so, but still, those earnings expectations for next year climbing, so those valuations at least a little bit more attractive in terms of at least next year.
Dom, it's so interesting when you take a look at these names versus some of the legacy or what we've called sort of the great chip names, the Dell, Cisco's, IBM's. They've seen more interest this year. And sure, if you look at the expectations for a year out, perhaps they have the valuation advantage. But when you start to look 5 years out, 10 years out, are these really sort of names to hold for the long term? So it's interesting to see that sort of divergence. What do you think is at play here?
Well, so it's interesting, Deirdre, that you bring that up because there has been a focus over the near term, call it the last 6 to 12 months, on some of that kind of at least value trade, right, within technology and communication services, so big tech and media companies. If you look at the names like Cisco or Intel or IBM or others, they've seen a bit of an investor tailwind over the last 6 months because of that general hybridization of the market. Folks want to get more into that value trade because the valuations have been attractive. And let's be honest, sometimes some of these mega cap technology stocks have run a little bit far in a good amount of time, a short amount of time. If you look at that the way that it comes down to it, Carl, Deirdre, Julia, everybody, I mean, just the notion here is that for many big cap technology companies, it will be about whether or not they become some of those buy and hold investments that people just kind of put in there and forget about because they are this generation's IBM or Intel or Cisco. So that dynamic changing is something we certainly have to watch in the coming months.
Dom, I have to ask, though, how the stay-at-home trade and now the reopening trade plays into that. If you look at a company like Netflix, I mean, that stock's only up by, say, 20, that's up about 22% over the past 12 months. And then you look at a company like Snap, its stock is up 250% over the past 12 months. How do you see these assumptions about what spending is going to look like as we emerge from the pandemic really impacting what valuations seem reasonable? So
at this point, the fundamentals, if you want to look at it this way, Julia, the fundamentals are going to matter with regard to just how much you're going to pay for growth, right? When it comes to companies like Snapchat or Twitter or Facebook or some of these other larger kind of social media companies, what it really comes down to is whether or not they can show those metrics that say, hey, we can justify paying that kind of a valuation because these companies are growing just so much faster than everybody else. And Carl, one thing to to remember, of course, in this, Netflix is still growing, albeit much more modestly than it has been over the last year with regard to subscribers. Whether or not those types of companies can continue to grow those types of aspects, to Julia's point, when work from home and stay at home is not as big a part of the picture, that's going to be a big thing to watch within social media to see whether or not people still engage in the same way or sign up in the same way as they did about a year ago. I know a lot of folks out there are saying, hey, if things get back to normal, I'll try to spend some more time outside and maybe not as much in front of the screen.
Yeah, that's something we're going to watch, obviously, on this hour, Dom, all summer long. Thanks, Dominic Chu. Still to come this morning, a new SPAC from Apple's former head of retail. We're going to check in with Ron Johnson next. Later on, that Elon Musk SNL saga continues to get weird ahead of the show this weekend. Tech Check's back in 3 minutes.
All right, guys, let's do a quick update here. So far, NASDAQ continuing to go downward. It's down 0.5 points now, which is, of course, going to hurt my portfolio and probably many others. But then we got the Dow and the NASDAQ continuing to go up. It looks like we did not quite see the S&P hit a high early this morning, but it got super close. Honestly, within 8 points, so that's insanely close. Dow same way, not quite at a high, but it is continuing to move forward, so we may see something going on. When we look at the cryptos, let's see where we're at. I mean, Ethereum is the cover story of today, and it is back up to nearly 3,200. It took a little bit of a dip this morning, just down to 3,095, and it's already recovered 2.5, 3 points since then, or 3 percentage points since then. So Dogecoin over 40 cents again for the first time in a little while. I mean, since it hurt that surge back on 420 day when it got to $4.20. Yeah. And, or sorry, 42 cents, not $4.20. Treasury yields spiked, or not spiked, tanked this morning and has made slight recovery, but it hasn't really recovered. It's just turned upwards just a little bit. Apple's still doing okay. Oil stocks are doing really well. Some recovery stocks are doing pretty good as well today. On the tech side, we got NEO doing okay, up 1%, but it's down from its peak earlier this morning, down 3%, so a pretty good swing. GameStop, as you guys can see there on the board, was doing all right today, nothing great, but all right, and then it just seriously took a crash there just in the last few minutes. AMC out of the gate doing poorly, tried to make a minor recovery and just didn't get there, so it's doing poorly. Of the meme stocks doing okay, Express is doing all right, Bed Bath & Beyond is doing okay, not great. Churchill Capital, which was looking really good last week, got up to near their week, crashing all the way down to 20 again. So had a couple of great days, and then now it's really not such a great day. So we'll see. And I don't know if that's just kind of because of the SPAC market or because are they still kind of feeling something because of the Tesla earnings call? I don't really know. Lumber hit 1,600 this morning. That's not good news for anybody unless you own a farm, a whole bunch of trees, and that's about it. I don't think that's honestly good for just about anyone. So anyway, today's one of those days where, opposite from some other days we had in the past last week, opened opened really well. Did really good. Have 8 first thing this morning, and since settling down about 1% on my portfolio. I'm down 5% since we peaked here last week, the week before. It's still down, man, 10%, weeks more than 10% from my high back in February. So still kind of a bummer, still kind of feeling the burn of that, not being up where I want it to be in February. So, we're really riding the wave back then, and now I'm not. So it's okay, guys. We're still doing okay. Still not going great, and we'll make it through it. Anyway, I'll turn it back over to the news here.
Including people and better homes and gardens. And the Environmental Protection Agency wants to sharply reduce the use of a potent greenhouse gas commonly used in refrigerators and air conditioners. The EPA is proposing an 85% cut in the use of hydrofluorocarbons over the next 15 years. That's comparable to eliminating 900 million tons of carbon dioxide emissions. You're now up to date. Carl, I'll send it back to you.
All right, Rahel, thank you very much, Rahel. In the meantime, retail startup Enjoy Technology is going public via SPAC today. $1 billion deal this morning. The announcement comes as SPAC deals, as you know, continue to slow down with half as many deals in April versus March. Take a look at the CNBC SPAC index. You can see how deal flow has slowed this year. Enjoy's Ron Johnson joins us today, longtime Apple SVP of Retail, alongside Chicago Cubs chair and Marquee Rain Acquisition co-chair Tom Ricketts, who's taking the company public via his SPAC. It'll be NASDAQ ENJY. Welcome, gentlemen. Congratulations. Good to see you both.
Morning. Well, it's great to see you, Carl. Good morning.
Ron, congrats. It's been a while. You've been at this now for, I think it's 7 years. And for viewers who perhaps haven't paid enough attention, I wonder if you can sort of restate the concept of commerce at home and what kind of market is addressable in that space.
Yeah, it's really simple. Shopping's been moving from the store to the home for 30 years, really led by Amazon, recently with all the speed to the door, but everyone's racing to the door. We believe the opportunity is to take the entire experience through the door. The home is becoming a new platform. Airbnb turned a spare room into a hotel. Peloton turned your home into an exercise studio. We're just bringing the whole shopping experience through the door. And we do it for world's big companies that depend on deep engagement. Apple's a partner here in the U.S. They depend on deep engagement as they roll out their services platform and want to shorten the upgrade cycle. A partner like AT&T for us is trying to win not just on high-speed networks like 5G, but broadband in the home. You have to go through the door to unlock those opportunities.
Tom, I can't even imagine the number of proposals that are crossing your desk these days. What did you see that you liked here?
With any SPAC sponsor, the first thing you're looking for is a public-ready company with a really exciting business model and a great management team. So then we were introduced to Ron and to Enjoy, and initially we're like, wow, this is great. It's unique, it's disruptive, it's scalable, it's very tech-enabled, it has huge global applications. But then as we dug even deeper, we liked it even more, and primarily because the customers love it. They have net promoter scores in the high 80s, which is, and I know a little bit about customer businesses. That's incredible. The partners love them. They have an incredible management team, as I mentioned, a huge head start in what is a really logistically complicated business, and a positive unit economics and a path to real profitability soon.
Tom, I'm so curious, you got a great head start in a year when everyone was stuck at home, but as people can return to brick and mortar commerce, as we see malls really feature experiential shopping, how do you think that the model is going to have to evolve as people want to get out and about more?
Does anyone know what the ticker is for this company they're talking about? I just want to buy them. I just want to come up.
Inexorable march up. And people now just have to simply choose, do I want a to-the-door experience, which we'll do most of the time because we buy online for convenience. But then in the future, we now have a through-the-door experience. And just like we like to go to a great store for an experience, we'll want to have an experience at home. So we see the future being very bright for Enjoy. And it's interesting, it's a global reach. We serve 80% of the UK today as we speak with our partners with British Telecom. We're in nearly 40% of Canada, and we're just getting started.
Tom, a question for you on the SPAC model. Recent criticism, and we heard from Buffett and Munger over the weekend, but more largely it has focused on major sources of dilution for new shareholders on things like the warrants and the promote. How much of the IPO proceed does your promote make up? How did you think about it in this process?
Yeah, and I think it's important in light of all the everything, all the noise in the SPAC market to kind of keep all this in perspective. I mean, ultimately, this is just one financing option for companies that need to grow, companies that are looking for growth capital. They have a couple different options. It is not, necessarily the best option for all companies. It really depends on the facts and circumstances of the company itself. In the case of Enjoy, like I said, a public-ready company with a great business model and global aspirations, it really was a great fit.
Did you do anything differently? How much was your promote, and did you include warrants at that typical price of about $11.50?
I'm not sure what's exactly public, but with largely standard terms. But there were a few tweaks, but largely standard, yeah.
Now, Ron, I know that you're here to talk about Enjoy and the SPAC, but I have to ask you, since you worked at Apple for so long, about this Apple Epic lawsuit, which has just got underway moments ago this morning. How do you view this case?
So I found it.
I don't know much about it. I'm so impressed with Apple. They've never innovated at the pace they are. What's interesting to me, though, I looked this morning and I saw that Spotify, which has a lawsuit in Europe, has a $50 billion market cap. Epic is nearing $30 billion. I wonder how these companies would do without iPhones in the App Store. And so it's really hard to determine pricing. I've been in retail my whole life. And when you get a great opportunity with a large customer base, you're going to pay for that. And we do that through rent in a mall, through margins, all these things. So it's a very complicated issue. And it'll be interesting to see how it plays out.
What the ticker name is for this company.
And finally, Tom, it's interesting. Enjoy seems to solve a bit of a puzzle for retailers who want to expand their footprint but don't want to go through the steps of actually committing to physical floor space. And we know what that retail's been through on that front in the past decade. I just wonder what your thoughts are regarding commercial real estate and whether rents have come down enough to make that a bit more of a tantalizing possibility, at least for some retailers.
Well, I tell you, that's a little out of my strike zone. I'm not a real estate guy. Obviously, there's going to be some big shifts and big trends as people wonder whether or not they're actually going back to the office, and there'll probably be some repricing of some sort. But Carl, I'm just the wrong person to ask about that.
No, I understand. I would have asked you a baseball question, but I wanted to cover something a little closer to the topic at hand. Ron, can I just throw that at you really quick? Whether or not the physical store has any marginal leg here, given what rents have done?
Yeah, well, rents have come down, and they probably will come down a little bit. But what's interesting as the footprint shrinks, at some point we'll hit equilibrium and rents will go back up again. There are a lot of great, exciting new tenants going into malls. There's a lot more restaurant. People like Peloton are going into the mall. So malls will survive, streets will survive, but it's a really tough time, as Tom said, until this work from home gets settled. The nature of retail will be very different, and I think a lot's going to change over the next period. But in the short run, I think rents will be pressured.
Yeah, you're right. That's an answer that we are not going to get definitively anytime soon. Gentlemen, it's great to have you back. We love seeing you both. Hope you'll come back again soon, and congrats.
Thanks, Carl.
Thank you.
Friday's double-digit drop-off, not enough for Cathie Wood to sour on Twitter. We'll break down her defense of the stock next. And later, is a foldable iPhone coming? Tech Check is back after this quick break.
And the entire time, I don't think they mentioned marquee investment, but I don't think they mentioned the actual name of the ticker. So in case you're wondering, it's MRAC. Market cap of 465. That's what today's chart looks like. Let's do this. Let me throw them up here on the top. MRAC. And I mean, their ticker's like nothing. No volume spike, no nothing after that appearance. So, I mean, if you want a SPAC under 10, and the SPAC itself launched today, it's not even like just the merger was announced today. That's, I don't know, a very interesting one. And the entire time in that interview, they did not mention the ticker symbol. So that's interesting. But they did create a little bit of buzz. They'll probably get some news articles out of that appearance. And then they may, and a lot of these SPACs do, end up on a couple of other news channels in the afternoon. And because of that, they might get some bumps. So I don't think the story is over for MRAC, even just today. I guess I've made a grand total of 25 cents now on that deal. Look out for those capital gains on that 25 cents. About 25. I'm going to put in a sell order for $12.99. All right, so you'll see it there on the top of the screen. Just put in a 25 limit to sell order for $12.99. If, what's that, $12.99 minus, I bought it for $9.95 times 25, that would earn me $76. So not the most impressive day trade in the world, but you know, every now and then I do still just like to cash.
Twitter shares down 20% over the last week, but despite its disappointing outlook.
So I didn't want to go too crazy and like 1,000 or something like that. I'm really wondering if there's an opportunity for me to invest a little more in Twitter. Actually, no, I actually currently don't have anything in Twitter. I have in the past. Let's see. Let's see, how far is Twitter? No. Clubhouse's problem is you can't just go join Clubhouse right now. Not just anyone can just go join Clubhouse. That's why, and it's a marketplace that I'm sure greatly because Twitter, Facebook, even stereo, and iHeartRadio might get into something like this, and all these really mature offerings. Clubhouse needs to get to where they can actually, if you can actually go on your phone, download the app, and sign up for Clubhouse. You can't do that right now. It's dumb. Twitter is actually lower right now, 16% lower right now. It was on December 23rd, 2013. It was right after its IPO, 41, and it's now nearly 8 years later, only 27. We're only at market by 40, so we can bring that. So Twitter might have a chance. Twitter's a good, long, sustainable platform to be a part of, then it might be a good investment. I've never, as a user, I've never been a good user of Twitter. And it just doesn't do it for me. I guess. So anyway, we're seeing continuing, not great day on the tech stocks. It's made a slight bump back, but still below 14,000 on Nasdaq. So that's unfortunate. Oil surging. A lot of the commodities are surging. Oil surging. Lumber, of course, is surging, and we're seeing a really good surge in the various cryptocurrencies. The four that I watch, pretty regularly: Bitcoin, Ethereum, Dogecoin, Litecoin, all up pretty good today, with Ethereum leading the way. Ripple's down a little bit, but it's still up over the past week quite a bit. So, got a meeting here in a little while, guys, and then after the meeting, I'll be signing off because I've got to leave for a little while, and then might be back this afternoon. We might just have a morning session today.
Yeah. 20 million foldable iPhones in 2023. Now, in Apple's most recent quarter, iPhone sales bringing in over $65 billion in revenue, up 17% year over year, with an install base of over 1 billion. Samsung is the leader right now in foldable technology. The Samsung Galaxy Fold and Z Fold 2 already on the market with a price tag that will set you back well over $1,500. We have reached out to Apple for comment on this report, but we have not heard back yet.
That could happen. They might have something, but then people are going to want to put case.
And Julia, Dell reaching a deal to sell its Boomi cloud business to TPG and Francisco Partners in a $4 billion deal. More on that online on CNBC.com. And next, a departure of Elon Musk's other startup. We are back in just a moment.
Too brittle. Bend every time you do something to it. I'm not big on folding phones. Not because it's different, or I can't get into something different. It could even fold into a larger phone and a better experience. I'm just more the usability of it, the functionality of it being a something that you can slide into your front pocket or your back pocket if you're a back pocket, especially really if you're a back pocket person. But I don't know. I'm sure I'm not doubting that they think of all these things and figure out. I've never really seen the Samsung folding phone. I'm sure plenty of people have it, and so they've already done it, and I'm sure Apple's heard all the good and bad and everything in between about the feedback on the Samsung phone since they decided to take the lead first. Apple does a really good job of not always being first to market on a lot of things, but still being the most popular in the market on things. And it's kind of interesting they've been so successful with that. It's going all the way back to the iPad or the iPod. Not that they were first to market, and easily accessible MP3 player and integrated downloading stream in our network and with iTunes. They went, I don't know if they're first. They first to a huge scale, but they didn't have the first MP3 player, and they didn't even have the best MP3 player back in the first couple of iPods. But they do a great job of still taking over that market share. It's a great strategy, right? Like, let the other guys do it first and then learn very, very quickly from their positives and negatives on whether or not something is a good feature or a bad feature or good or whatever, and then we'll go to market with ours, and then we'll just dominate the market with what it may not have as many features, but it'll have only the most popular features, and people will love us. It kind of seems like their strategy. So, they might do a folding phone and dominate Samsung's folding phone because they'll take away the things that no one likes and they'll put emphasis on the things they do like. So, anyway, all right.
Neuralink, Elon Musk's brain implant startup, is losing its president and its co-founder, Max Hodak, taking to Twitter to share news of his departure, but he did not reveal the circumstances around his exit. Musk, who's one of the company's 7 co-founders, has invested tens of millions of his own money into the venture. And last month, Musk boasted that Neuralink's devices could enable, quote, superhuman cognition and allow paralyzed people to operate smartphones or robotic limbs with their minds someday. We should note, though, that neither Musk nor Neuralink have provided evidence to back up these claims, Carl, which have received some strongly worded pushback from the scientific community.
Indeed, guys. And one more thing, as we get closer to the top of the hour, Musk is set to host SNL this weekend, as you probably know. Not all the cast members appear that thrilled about the idea. Musk tweeted, throwing out some skit ideas for SNL. What should I do? A few of his ideas are Irony Man, who defeats villains using irony, and Baby Shark and Shark Tank merging to create Baby Shark Tank. Close to 50,000 people commented on the tweet, including SNL cast member Chris Redd, who says Musk may want to start by calling them sketches instead of skits. Julia, it's early still, but I think this show is going to get a number.
Oh, painful. I cannot wait to watch this show, Carl. It's going to be fascinating. It's going to be fascinating, especially to see how all the cast members interact with Musk. Now, agree or disagree with the Oracle? The best comments on today's crowdsource are coming up next. Tech Check is back in 2 minutes.
today, we asked what you made of Buffett and Munger's comments on Bitcoin at Berkshire's shareholder meeting over the weekend. Bitcoin bull Anthony Pompliano says Buffett should have bought instead of sitting on a pile of cash this past year. Bitcoin up over 500% over the past 12 months. One user saying he agrees with Buffett, finding it hard to actually value Bitcoin as an asset. Another arguing Berkshire needs to bring in younger management who may be more open to Bitcoin and the crypto markets in general. And Carl perhaps understands the use cases beyond kidnappers and extortionists.
Yeah, no, I'll tell you what, Munger and Buffett, they took no prisoners on Robinhood, on Bitcoin, on SPACs, just a remarkable flood of news. And our thanks to Becky, of course, helping get some of those headlines over the weekend at the Berkshire meeting. We're going to, in the morning, start with earnings once again. Pfizer, DuPont, later in the week, Roku, Peloton, you name it. Let's get to the half.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Your money in May and whether stocks are about to take a new leg higher. We debate that with our investment committee, get their best plays right now as well. Joining me for the hour today, Tiffany McGee is the CEO and CIO at Pivotal Advisors. Steve Weiss, Jim Leventhal, Joe Terranova rounding out the four today. It's good to see everybody. Go to the wall. Let's take a look at where stocks are right now. Everything's green except for the NASDAQ dip red by about 1/3%. Most of the critical earnings are now over. Most of them above expectations, too. I'm starting to wonder what the next catalyst is going to be, Jim Leventhal, because one of the big stories now, earnings great, stock reaction not great. What's up?
Yeah, well, I think you got to respect the price action last week, Scott. And, we talked about it last week, and you're bringing it up now. It was frankly not good. I mean, it wasn't terrible, but it was certainly meh. It was tepid after blowout earnings from tech. So we're certainly not getting a catalyst from tech earnings. Now, you do have a bunch of industrials and energy names reporting this week. I think they're going to be good, but honestly, I'm not expecting a strong market response. I don't think this is fatal, though, Scott. I don't think this is something where you've got to do that sell in May thing that I absolutely hate. I hate that adage. I don't think it's useful at all. I think at worst what you've got is a sideways consolidation period here. But you get into the summer and you get a little bit more clarity on taxes for next year as those negotiations go on. And you may hate my saying this, Scott, but even though Jay Powell was very crystal clear last week, I still think the market doesn't believe him. And over the summer, if he's going to start talking about tapering, that would be the time to do it. So maybe if he doesn't, then the market gets a little bit more wind in its sails. All of which says throw out that adage of sell in May. It's a useless adage, especially when you've got as much going on this year.
Just go by history's sake. I mean, in the last 8 years, the major averages have only fallen one time in May, and that was in 2019. So
yeah, look at last year.
Yeah.
Look at last year. If you sold in May last year, you missed out big time.
Well, I mean, come on. I mean, the cavalry came to the rescue along with the Army, Navy, Air Force, and Marines. I mean, let's, okay.
He doesn't make it less real.
I hear you. Asterisk, though, in 2020. Steve Weiss, where does this leave us now? Best month for stocks since November. As I said to Jim, earnings, I mean, you can't find anything wrong with earnings. I said 87% of companies have beaten expectations. But since earnings season started, stock market's done next to nothing.
Well, look, I think what we've got now is a period of digestion, and that's typical after earnings. Nobody had been expecting that earnings were going to disappoint. Everybody was very enthusiastic, so they positioned ahead of it. Now, I can't tell you that I wasn't surprised, along with the rest of the world, that Amazon actually closed lower on the day Friday after what can only be termed a phenomenal record-breaking quarter. So it's period of digestion. We're still looking forward in terms of deciding how to get invested in terms of the general market based upon what Jim Leventhal pointed out, the Fed. So you have Lee Koopman with his interview, you have Buffett, you have Munger, all calling out saying, hey, inflation is going to pick up. Nobody sees it as transitory except Yellen and Powell and his colleagues on the Fed. And I think that's the issue. Now, going into that, we've got some modest numbers today in terms of economic reports, but it's going to be a big number that we're looking at on Friday in terms of payrolls. 1 million right now is the baseline narrative. If we see much more than that or much below that, then you could see some action in the market one way or the other. But with the insatiable appetite that foreign countries have, sovereigns and businesses for U.S. 10-year and other bonds up and down, as we've seen in the auction, as long as rates stay under control in terms of yields, not Fed rates, you'll get confirmation in the market. And I think the market moves up, but you can see it trade down. What's more important is where you are in the market. And despite where the VIX is, that belies what's actually happening in the rotation.
Well, hold on a
So
second. I'm going to stop you right there. I'm going to stop. I'm sorry. I'm going to stop you right there. You said it depends where you are in the market, right? That's everything. You lowered your tech exposure.
Yep.
You trimmed Micron. Okay, tell me why.
I did. Yeah, so I went into Micron as a trade, and it sort of didn't work out. So I cut it back. I still think it's cheap, but you know, I'm looking to increase, which I've been steadily doing over the last 6 months, a year, into the cyclical exposure. So as I mentioned on the show on Friday, I increased my position in Atcor. Look at that stock today. Phenomenal quarter. It was also weak, well, basically flatlining after the quarter. That's a cheap stock. I increased LyondellBasell, which is LYB. They had an excellent quarter as well, but the stock actually traded down on it. So I think those stocks are more likely to do well, given that they're selling at like 10 to 12 times earnings, and lower in some cases, than some high-flying tech stocks.
So, Tiff, tell me how you view the markets as we enter May. I'm reading a headline right in front of me. Governor Cuomo announces the elimination of state-mandated capacity restrictions in New York on May 19th. So we're going open, right? We're to the point now where we're going full throttle open in the next few weeks. The economy is going to continue to recover. The stock market clearly knows all this already. So what's the next catalyst to take our viewers' money higher?
Yeah, you know, we are in about to be in full reopen mode. And as you mentioned earlier, stock fundamentals are extremely strong right now. You know, in terms of earnings, 87% above expectations. Also, consumer spending is strong, and consumer savings is strong. So they're going to have money to continue to spend when we get into a more full reopen environment. So, you know what, I'm looking at, and earlier, you know, we were talking about the market, how strong earnings are, but then that link to markets, right? So I think we have to pay attention to investor reactions. It's not just the good news, but how are investors looking at this and how are they reacting? So, you know, I'm not selling in May. I'm actually buying, and I'm looking at two things. Number one is opportunities to buy the things that I love that are on sale. Right? That's just very, very clear. Number two,
a shopper at heart.
I'm also buying the stories. Of course, yeah. Number two, I'm also buying the stories that people are not paying attention to, right? So again, we're still in this stock pickers environment. There is definitely opportunity there, and you can't paint all this in terms of like, for instance, like broad brushes like industry and things like that. It's not the pure plays, but it's really the larger themes that I'm paying attention to and looking for those opportunities within those select opportunities within those larger themes.
Okay. So, Joe, I look at what's happening with your Joe T ETF, which to me tells a really interesting story here. As you rebalance, right, you've got a lot of stocks that have been sold of the growth variety, Salesforce and Visa, I'll put that in there, Netflix, Electronic Arts. Okay, you've got some staples like P&G, et cetera, but you are rebalancing, I would say, more heavily tilted towards value and cyclical stocks.
Absolutely, without question. Financials, the largest sector increase in the most recent reconstitution, which happened on Friday's close. You asked before, what's the catalyst for the market? Looking forward, we are past earnings. We understand there's an economic recovery. I suspect the next move in the market, where flows of capital will shift, are related to global COVID trends. What does that mean? That means the pause in appreciation that we experienced for Treasury yields, well, that's going to resume back higher. I think yields will move higher. It's a cyclical orientation once again, longer duration assets in which Stephen's probably correct to move away from technology. They're going to struggle. And ultimately, Scott, understand the positioning of the S&P 500. We now sit 14.5% above the 200-day moving average, 7.5% above the 100, and nearly 5% of the 50-day. So a pause or certainly a correction is something that the market is thirsting for. But I think in this continued reflation and rotation, which has been the story of 2021, it's now time to go back to the cyclical orientation, financials, industrials, and energy.
Jim, you're going to have a hard time convincing me that we are going to be bombarded with great news for the next, I don't know, however many weeks, 6 weeks, 8 weeks, 10 weeks, 12 weeks, whatever, of great economic news. The reopen's great. The recovery's great. People are traveling. People are eating out. People are doing this. GDP's off the charts. You know, okay, rates may go up, but I don't know who thinks they're going to go off the charts themselves. The market's going to have a correction in the face of all of that good news? Even if a lot of it's known?
I don't think
we're still going to have a correction in the face of all that positive feeling?
I think your argument makes sense. I don't think we're going to have a correction. Now, plenty of people will say that we're overdue for a correction, but that's another meaningless statement. And it's more meaningless when you consider the power of the Fed. The liquidity in the market, low interest rates, even at these levels, have stopped any correction for the past 14 months dead in its track. I mean, if you blink, you missed when we were down 9% in September and again in October. And I mean, it was for one day and it bounced right off. That's not really a correction. We haven't been down 5%. I don't think this year. I might be wrong on that. When you go back to what I was saying at the top about this lackluster price action, I want to repeat, none of this is fatal. I think what you're looking at here is that we're going to be sideways and we're going to be kind of bored for the next few weeks. The one thing that I think will move the market one way or the other is the Fed. I mean, for years now, I mean, going back to the great financial crisis, we have learned again and again the power of the Fed. If the Fed convinces the market that it's on hold for longer than the market thinks, then we're going to see a rally. If, on the other hand, the Fed says no.
Right? I mean, how many times didn't we learn our lesson already?
I think so, Scott.
Some of the same voices, by the way, who were out there in 08 and 09 saying, oh, my God, you're going to have runaway inflation because what the Fed is doing and we're printing all this money. The government's come to the rescue. I'm still waiting for that to happen. And now you get the same voices coming out again, talking about inflation being here to stay. And, oh, the Fed doesn't know what it's talking about. How can you call this transitory or temporary? Did we already learn our lesson when the Fed is engaged to the level that it is? Not to mention with the many trillions of dollars coming out of the Treasury, that you sort of avoid that?
I feel like you're violently agreeing with me. So maybe I wasn't clear before. Right now, the default is that the Fed is going to keep accommodating the market. That Jay Powell couldn't have been clearer last week, right? The market doesn't believe it. You look at the Fed funds futures market, it says we don't believe you. You know who's likely to be right in that condition is Jay Powell. And, you know, when the market wises up to that, which I think it's going to take a few weeks, okay, maybe even a couple of months. But when the market does wise up to that, I think that's when the market goes higher.
Well, to the point that Joe made earlier as well, Tom Lee 100,000% agrees with where Joe is. Economic activity accelerated in May, plus the COVID retreats that we've all talked about, equals a cyclical trade resurging higher. Right, Steve? I mean, that makes perfect sense, doesn't it? Tom Lee's been right. Is he going to be right again?
I think he is. And if you're always bullish, you're going to be right 90% of the time. So, look, I do think it is cyclical trade, as I mentioned before. And I did add financials also, as I mentioned last week. I wouldn't say they've all been left behind, but they've not mirrored what we've seen in some of these high-flying tech stocks. So you want to be there, but here's why I believe it's going to be different in terms of inflation. And whether it's sustainable or not, we won't know for a couple of quarters at least, maybe 3 quarters. So you got to give the Fed, you got to listen to the Fed. But we're on the cusp of a synchronized global economic recovery. We haven't seen that. And we know that supply chains are tight. We haven't heard that coming from companies in the past when the doomsayers before, who are always bearish, always saying inflation's going to run away. We haven't seen that for years and years and years. We're seeing it now. We haven't seen iron ore at $1,700 or $170. We haven't seen copper at all-time highs. We haven't seen, you know, if you look at the Baltic Dry Index, which I was looking at today, we haven't seen that as high as it is.
I don't know. I can't tell. How many times have we said on this show?
It's coming.
How many times have we said on this program, and I'm not talking in the last 12 to 15 months, but before that,
Right.
synchronized global recovery or synchronized global growth. We've used it many times because that's been the scenario many times, and yet inflation has not gone through the roof in any of those occasions. So,
I will agree with you. We've said it many times in the past. I've said it as well. But we've said it in response to market questions. Now we're seeing it in response to, look, the world was shut down for a year. And when the door opens, that door's not big enough to accommodate everything that wants to go through it. So what happens? Prices go up. We haven't seen chips be in rare, rare commodity where you couldn't get enough of them. We've not seen that. We've always complained too much capacity.
But that's
I
precisely why.
think that this time we do have inflation.
That's precisely why the Fed blew the wall down, right? There is no more door, right? And so everybody can fit through.
Right.
I get prices are going up a little bit. Prices aren't even where the Fed wants them to be or is willing to accept them to be, even a little bit hotter than where they want them to be for a longer period of time than I think the market is even thinking about. Let's take the conversation a step further. I want to try and figure out how we can make people money in the next, I don't know, at least a month. And the issue of the fact that the stock market hasn't moved that much since earnings season really got going. Jonathan Krinsky is with us now. He's, of course, the technician with Baycrest, says that's not a good sign. The proof's in the pudding, right? The numbers were great. The commentary's great. Why didn't the stocks move?
Yeah, Scott. So that's a great point. And, I think one thing that's really important here is that stocks are not the same as companies, just like the market is not the same as the economy. And if we go back to March of last year when the market bottomed, think of how bad the news was. Think of how bad the news was going to continue to get. And yet the stocks had already reflected that and they moved higher from that point. So I think we're in a bit of almost the opposite now. Things are great. They may continue to get a little better even from here on a fundamental basis on the macro front. But stocks are smarter than that. They've priced that in. That's why they've rallied so strongly up into this point. That was part of our Nirvana call where we thought growth and value is going to kind of have this crescendo move or both work together. And that was kind of going to be as good as it gets. And we're seeing, some signs of that now. We've seen some of the speculative long duration parts of the market like IPOs and SPACs and clean energy. A lot of those areas of the market peaked in January, February. And a lot of those single names by our work are probably never, or I shouldn't say never, are not going to be back to those peaks for a number of years. And then now we're kind of moving up to scale a little bit. We've had some of the semiconductors report great earnings, but on an equal weight basis, semiconductors are really starting to break down a bit here. So, I think it is, you have to pay attention to the message of the market. You have to pay attention to what the price action of the stocks are telling you. And sometimes that doesn't necessarily line up with what the companies are telling you.
Let me ask you this. How can we declare that this is as good as it gets if we don't even know how good it's going to be?
We don't know. But again, that's why we watch the stocks. That's why we watch the market. We're seeing the market speaking, and some of these tech names are speaking, and they're not reacting great to earnings. Now, some of them are fine, right? Let's give it a little more time. Names like Facebook and Google, even Amazon last Thursday, they haven't really made material weakness off their earnings prints. They're just not rewarding you much for those blowout earnings. So I think, you could argue that we don't know enough yet, but I think, when you start looking at some of the semi names, some of the more high growth software names, these are not the type of moves that you would expect from a new sustained uptrend.
Well, I mean, you do have supply issues within the semiconductor space, which is playing a role as well. Now, the other point of view of Bank of America and Savita Subramanian today writes, we're cautious. Why are we cautious? Well, because nobody else is. Now, maybe there's something to that, although you do feel like people are trying to become a little more cautious. What it was 2 weeks ago on this show, I went down a list of all of the big names who were growing more cautious, talking about either euphoria is here, it's time to step back, or we're definitely going to have a correction. Was it Tony Dwyer a couple weeks ago was talking about a 10% pullback? But how about this idea of we're cautious because just nobody else is?
Yeah, sentiment's a funny thing. And, sometimes you have to separate what people are saying and what they're actually doing. And, we don't always love when there's a lot of strategists also calling for a pullback. Sometimes that makes it harder for it to happen. But I think if you look at some of the positioning data, some of the transactional indicators, put call ratios, I think people are pretty well invested here. I think there's a bit of complacency. The S&P, in our note last week, we talked about how the average trading range is down to around 50 basis points on a 10-day basis for the S&P. That's pretty tight. There's not a lot of fear in the actual market, despite the fact that I think a lot of people are starting to maybe call for a downside. So from our perspective, it's more important what people are doing with their money than what they're saying. And it's our sense that people are pretty fully invested here. So that's part of the call as well, that I think there could be some unwind to that positioning.
Oh, okay, hold your thought for a second. Let me go to Tiffany McGee, because she's voting with her pocketbook. She's buying Shutterstock, a stock that's up 140% in a year. She bought more Estee Lauder, which I think is up more than 70% over the past year. So what does that say?
Well, I think...
No, let me go to Tiffany first. Oh. Sorry, Jonathan, I should have been more clear. Let me go to Tiffany, and I'll come back to you.
Yeah, so Scott, I said before that I'm looking for opportunities to buy the things that I love that are on sale, and one of those is Estee Lauder, right? And so, I understand, they definitely released earnings, and it was a little, their makeup sales were down, but skincare was up, and it's continued to be up, right? And so, no one's buying makeup right now. They haven't for the past year, for the same reason that the only the only shoes that I've bought all year have been sneakers, because we're at home, not doing anything. And so for me, Estee Lauder is one of those staples. It's been down for the past couple of days, and especially on the news on earnings. So, it was an opportunity for me to buy, and I'm very, very excited about that. All I have to say is MAC Makeup, La Mer, these hero products are just continue to be to do really well, and they've spent on skincare. They kind of transitioned spending from makeup to skincare, which has really served them well. And then the second thing, in terms of Shutterstock, this is one of those opportunities that I think people really aren't talking about, right? And so for me, I try to stay away from the stay-at-home and reopen kind of plays. So does he. I try to stay away from these stay-at-home and reopen plays. But I do think that Shutterstock is a very interesting story. They've more than doubled. The stock has actually more than doubled in the past 12 months.
Yeah.
And really, as the economy reopens, markets are spending really on powerful content, right? So creative tools, marketing technology, and really kind of seeking to create these impactful ad campaigns. And these are, the businesses that are spending on these are both large and small. So I do think that's a really good opportunity here. And that's why we bought it.
I mean, Shutterstock, it's not an unknown story, clearly. I mean, it's up, as you said, more than 100. It's 140%. In the last year, nor is it unloved. Now it is 16% off of its 52-week high. So there has been an opportunity presented to you.
Absolutely, but it's just not one of these things that we're talking about all the time, right? So we tend to talk about the Amazon, even Peloton, Zoom, all of these things, but we're not. I mean, it's definitely known, but I don't think people are paying attention to it. Subscribers grew 46%, right? And subscriber revenue was up 20%. So we really like it, and we just don't think it's a crowded situation right now. So it's an opportunity.
Okay. So Jonathan Krinsky, I go back to you using Tiffany as the perfect example of, maybe there's a broader narrative of underestimating the power of the reopen and the recovery. And some stocks have pulled back enough where you have people who say, you know what, even though it was up 140% over the last 12 months, there's still a lot more story to be told here.
Yeah, I think this is an example of there's always stocks and stories that are going to work. This is not a major 07 type top where everything's going down. I think some of the more speculative areas of the market have corrected and they're not bouncing. And I put a lot of the SPACs, the IPOs, some of the clean tech energy, the fuel cell names. If you look at charts of those, a lot of those dropped 30 to 50% and just haven't done nothing, even as the NASDAQ has come roaring back. I also just want to touch on, she mentioned Estee Lauder. We think that's a consumer staple. We actually have been noticing some of the consumer staples names, the more traditional ones, some of the names like Molson Coors and Kraft Heinz and Hershey and Mondelez. Some of these names if you look at the reaction of those to earnings, those have actually, a lot of those have gapped up and had followed through to the upside. So from our work, we think those were probably under-owned. People were more cautious or bearish on those going into earnings. And the reaction tells you that there's still money going into those names post-earnings, as opposed to some of the tech names, some of the more speculative names that we mentioned. People seem to have been overly confident in those into earnings because they knew numbers were good, and then subsequently they've sold off. So I think there is a bit of two-way action going on in this market. But I think if you're talking about the S&P 500, if you're talking about the NASDAQ, it's those big tech, communications, and discretionary names that are going to drive the price action. And to us, those just don't act very good right now.
All right. Joe Chernoff, you have a quick question for Jonathan?
I do, Jonathan. I always like to look for anomalies within the market and see what the message might be. Over the last 5 days, the S&P is slightly higher. But when I look at some areas of where investors were re-risking and emerging growth, you're going to see horrible performance. You've got Twilio, DocuSign, Zscaler, CrowdStrike, all down between 5 and 7%. Even to Scott's point before, look at the performance of AMD after earnings. It's down 5% in the last 5 days. Do I just ignore that? Do I buy the underperformance? What's the message in that anomaly?
No, that's a great point, Joe. We've been noticing quality. Investors have been going up the quality scale. And a lot of those, those kind of core stay-at-home names that did so well last year, those have not recovered after their correction from February and March. And to us, it's always a question when something pulls back, is that an opportunity or is that showing signs of further downside? And it's kind of getting to the point where it's to us, some of those pure stay-at-home names like a Peloton, like a Teladoc, like a Zoom, they've had their chance to kind of reassert themselves in the rally. And the fact that they haven't tells us, we would probably be avoiding those. But it's clear that investors are going up the quality spectrum a bit over the last couple of weeks.
Yeah. Jonathan, we appreciate it as always. Enjoy the conversation. Jonathan Krinsky of Baycrest. Consumer staples, they're the worst performing sector this year. Now, one stock in that space got a double downgrade today called dead money at best. You have to see if it's in your portfolio. We'll tell you next. And as a reminder, you can always watch or listen to us live on the go on the CNBC app. We're back on the half right after this. All right, welcome back. We are showing you shares of Twitter, which are off the worst levels of the day. Pretty good-looking spike, though not quite enough to take it positive yet. There's a Bloomberg report that says Elliott Management, Paul Singer's Elliott Management, was said to buy over $200 million worth of Twitter shares on the pullback in that stock. What's interesting to note as well is that ARK Invest, Cathie Wood, bought more Twitter late last week, 1.3 million shares on the pullback. So a couple of big names buying Twitter on the dip. You can see shares are still down 1% on news of that report now. What's interesting, Joe, is that not that much ownership on this show. The talk, I guess you call it, of Twitter not doing well in the aftermath of President Trump leaving office. I'm not sure what you make of the fact that Cathie Wood's bought a lot more on the dip, and now Elliott's Paul Singer has bought a lot. And I also, obviously, given the fact that he is a well-known activist investor, what then happens next in this story?
I think the buy from Elliott Management is far more important. To your point, the fact that Paul is a very successful activist, what does that mean for the board? What does that mean for the future growth of Twitter as it relates to the platform? Are we going to be introducing some form of content in which those that contribute are actually being paid for their contribution? So I think it's clear that somewhat of the toxic culture that exists on Twitter needs to be cleaned up as we move forward. And I think a lot of Paul's representation here in buying the stock might be focusing most on the fundamentals, the policies, and the way it aligns itself with a lot of positive contribution for social media moving forward.
It's worth noting, I mean, this is not a new position from Elliott in Twitter either, Steve Weiss. And we've been reporting on what Elliott wanted to do for the better part of more than a year. They have a seat on the board as well. So this is just buying more on the dip, taking advantage of a pullback. But you put Cathie Wood and Paul Singer, together, who clearly think that there's an opportunity and a story to be told. The stock pulled back late last week on earnings. I had mentioned, the interview that Ned Siegel did on Squawk Box following the pullback in the stock. I just didn't think gave investors all that much to work with. How do you view this story moving forward now with the context of Paul Singer buying more and Cathie Wood buying more?
Well, like Joe, I put more on Paul Singer, and the person that runs his activist for him in technology, Jesse Cohn, I've made a lot of money following. He's got a lot of companies sold. There's speculation that Akamai will be sold as well because they are there. In terms of Twitter, I put less on Cathie Wood because if you look at her trading each day, she could be there now. Stock could run 20%. She could be out completely. So it's not a long term. And I agree with you on Ned's interview. It left me less than motivated to get involved, and I was willing to buy the dip. He also discounted the fact that Trump leaving had hurt them because they picked up so many more users. But Joe hit the nail on the head. They need to get content there to compete with TikTok, to compete with Instagram, and they don't. So it seems like the world is passing them by, and they got to get it on their horse. And I'm comfortable Jesse Cohn could help them get there, but hasn't yet.
Well, there was that report, speaking of what's next, that they may have been in the market for Clubhouse. And I can't remember. It was like $3 or $4 billion, I think, was the number that was right. Thrown out there. They have Twitter Spaces. So, they're at least thinking about what the future is going to look like. We'll continue to follow the story. What's that? Okay. Thank you. All right, up next, the big ETFs to watch today. Plus, do not miss the CNBC Small Business Playbook. That's tomorrow. You can join some of the most trusted voices in business to provide critical advice to help owners overcome extraordinary obstacles and stage a comeback. You can check out the full lineup. You can register at cnbcevents.com/small business playbook. We're back after this.
I'm super excited about. Dylan's
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. Some major travel and tourism groups are urging the U.S. and Britain to fully reopen air travel between the two countries. In a letter to President Biden and Prime Minister Johnson, travel industry leaders say that many restrictions can safely be dropped to help tourism and business travel rebound. German prosecutors say they have busted one of the world's largest darknet platforms for child pornography. They say the sites have more than 400,000 registered members worldwide. Moderna says that it will provide up to 500 million doses of its coronavirus vaccine to the United Nations. They'll go to the COVAX program, which is sending vaccines to developing nations. Moderna's deliveries are set to start in the last 3 months of this year. And the head of the World Health Organization says that the COVAX program needs $35 to $45 billion next year. And Scott, that's just to vaccinate adults. I'll send it back to you.
Thanks, Rahel. All right, now to Bob Pisani. He has today's ETF Edge. Hey, Bob.
Hello, Scott. Good to see you. There's been huge inflows into ETFs this year, and especially in May. One sector continuing with record inflows, ESG. Another record quarter, another record month, and they're headed for another record year. Joining us to discuss is the man who runs the biggest ETF family in the world and the biggest ESG suite of products. He's Armando Senre. He's the head of BlackRock's iShares Americas. Armando, you launched your newest ESG fund, Carbon Transition Readiness ETF, for companies with a preference for lower carbon emissions. You just did that 2 weeks ago. You've already got $1.3 billion in assets. Has climate change now become the wheel that is steering the ESG ship? What's motivating ESG inflows?
Yes. Hi, Bob. Great to be here. Like you said, I think that first of all, I would say that for investors, climate is top of mind. As you know, it's a priority for BlackRock to build more products to allow investors to incorporate climate into their sustainable views in the portfolios. In the case of the low carbon transition suite of products, you mentioned LCTU. We actually launched two, LCTD, which is international, and LCTU, which is in the US. Both of them close to $2 billion in assets, largest active ETF launch ever. And I think that the reason that product is exciting is because we work with, we partner with some of the most sophisticated investors in the world. I know you had Chris Elman from Castors a couple of weeks ago when we did the launch. They participated in this offering. And that's a way for investors to get exposure, in the case of LCTU, to the Russell 1000, but with 50% lower carbon emissions in the portfolio, in the overall portfolio. So very exciting product range. And like you said, we just crossed 100 billion in assets overall in sustainable ETFs at BlackRock. And one of the areas that we believe the category will grow to $1 trillion by 2030.
Yeah. I'm amazed that there is such a strong interest from a new class of investors that are driving interest in climate change. But I can't help but noticing the top holdings in the carbon fund, they're all mega cap tech names, which we see all the time in ESG funds. Apple, Microsoft, Alphabet, Amazon, Facebook. Those are the top holdings. Why do mega cap techs appear in so many ESG holdings? Is there a diversity problem in these top ESG funds?
No, what I would say is that you have to look at sustainable is not the same for all investors. Different investors take a different approach to how they want to incorporate sustainable in their portfolios. So in the case of the low carbon transition portfolio that we talk about, the LCTU, you are trying to get exposure to the Russell 1000. This portfolio is an active ETF. What we can do is we can overweight and underweight, but again, with a low tracking error, 100 basis points of tracking error, trying to give exposure to the Russell 1000. But at the same time, the overall portfolio has 50% lower carbon intensity than the Russell 1000. That is the objective. And what we try to do is we double down on education to, again, help investors understand the different groups of products that they can choose to incorporate in their portfolios.
All right. Thank you, Armando. And now Armando is going to join us for an extended discussion on this topic and other ESG trends, as well as trends in the hottest investments of last year. And that's thematic tech ETFs. Remember clean energy, cloud computing, 3D printing, cybersecurity. Hot in 2020, not so hot in 2020 so far. We'll talk about that. Armando will be joined by Sal Bruno, the Chief Investment Officer, Index IQ, and Todd Rosenbluth from CFRA. ETFedge.cnbc.com. Don't miss it at 1 p.m. Eastern Time. Halftime back right after this.
Welcome back. Wells Fargo today double downgrading Clorox to underweight from overweight. The firm calling the stock, quote, dead money at best. They think more downside is ahead, obviously. It's the worst performing stock in the consumer staples area this year. That group was the worst performing sector so far in 2021. Now, nobody owns Clorox, at least on the panel. If you do and you're watching, we're going to do this through the prism of staples. Jim, you own Walmart, okay? I was shocked when I looked last week, and Walmart hasn't done anything. So what's up with the staples trade?
Yeah. Well, I think you can have some staples in your portfolio, but it's not the go-to sector right now. Walmart's been consolidating. I'd like to think that it's breaking out, and I look at this more as just consumers with stimulus checks that are going to buy.
That's the new term for doing nothing.
That's the new, that's the new and the old term for doing nothing.
Well, I mean, because look, the stock in 3 months, we're talking Walmart, which a lot of people I know do own, is up 0.5%. Year to date, it's down.
I think you can own Walmart.
Year, what? What's that?
I think you can own Walmart. I think it's wrong to put that in consumer staples because there's growth there, and it's coming from stimulus checks. It's coming from all the people with money in their pockets. So, I think it's now ready to break out. We'll get earnings in a couple of weeks. Walmart, I'm not worried about. Clorox, I think Clorox has got problems. They preloaded last year their sales for the last 2 years. They're going to go down earnings next year over this, and it's trading at a 22 multiple with raw materials going up. That's a bad story, but that's not Walmart. That's not even close.
Okay, Joe, you're playing the staples through Monster Beverage, which is interesting.
Correct, and that has been clearly the secular growth story over the last couple of years. They continue to diversify the product line, the introduction potentially of hard seltzer at some point, and clearly that's where the momentum is. But I think overall, just as it relates to the staples, whether it's Procter & Gamble, whether it's Clorox, as Jimmy said, there was a significant pull forward on the revenue, and now you're in an environment, and this is very critically important to understand, is raw material costs are going to continue to rise, and that is going to impact consumer staples both domestically and globally.
All right, we're going to take a quick break. We'll come back. Ask Halftime is next, and we have multiple video questions coming up today. Exciting. You can send one in. We'll play it on the air. Ask Halftime at CNBC.com. We're back after this. All right, let's answer your questions. First question for you, Tiff.
My question today is about Netflix. We'll all be streaming less hours, and Netflix will be raising prices. Does that mean we're going to all cancel our accounts? I don't think so. Netflix is going to continue to expand internationally. This should all help slowing domestic growth. What do you guys think about Netflix with a buy-in at a price point of $500? Thanks a lot. Go Lions.
All right, Rich, what's the answer, Tiff?
Yeah, so I love the Netflix story. I keep kind of going back to, and Scott, we've talked about this, you know, this is the company that started selling DVDs by mail, right? And so this evolution of them from DVDs by mail to streaming, from US content to global, authentic, local content in different countries, and from licensed to, you know, original production. I love the story. Netflix's balance sheet is also super strong. They're going to break even on cash flow this year and be positive by 2022. I would also, you know, definitely be looking for opportunities to buy Netflix in the dip. But either way, I think you just have to own this.
Okay, thank you for the question and the answer. Steve Weiss, now a video one for you.
Hi, everyone. Big fan of the show. I have a quick question for Steve Weiss. What do you think the future holds for Vuzix Corporation, that stock symbol VUZI? Should I hold my gains or should I keep adding at these levels? Thank you so much.
Thank you for the question. All right, Weiss, have at it.
VUZI is not in the sweet spot in terms of stocks the market's looking for because of what is a premium valuation. The news flow continues to be extremely positive. There is no competition in the market. Google Glass is like prehistoric compared to Vuzix glasses. So I say you just be patient with it and let the market come back to it as news comes out. They'll report earnings on the 10th, and I think the stock will start to lift again.
All right, it's a big winner year to date. Jimmy, finally, Farmer Jim, a video question for you.
Hi, guys. This is Sid in Toronto. I have a question for Jim. Should I buy GM in advance of the earnings next week, or should I wait, or should I consider options? Love the show. Thanks.
All right, thank you for the question. Should I just answer it, Jim? I mean, should I just answer it? I mean, I know where you're going on this, right?
No. There's a,
Can I answer it,
specific
Scott?
answer.
I know where
Buy
he's
some
going.
now. Wait, everybody stop. Earnings are on Wednesday, okay? So that was from last week, that question. Buy some now, but save some dry powder for after earnings, okay? The earnings are going to be fabulous, but there's going to be some hand-wringing about the chip shortage. Buy some now, but keep some on hold for after earnings. And the options are not the way to play this. This is a long-term investment. Don't get caught up with options that are going to expire perhaps when you don't want them to.
All right. I mean, the risk is doing a Joe Terranova, buy high, sell higher, right? I mean, that's could be the risk.
Nothing wrong with that. Buy some now.
All right. Buy now, buy higher. Maybe better said. All right. We'll do final trades next.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
Okay, welcome back. We will do final trades in just a minute. However, Tiffany, I want to talk to you first about FedEx and UPS. You own both. Both were upgraded today at Wolf to outperform. Those are some of the kinds of stocks that have been leading today, and they play right into the reopen.
Absolutely, yeah. And so for me, I own both of them. This is a play on the significant, increase in e-commerce growth in 2020, which I think is really going to continue. So for me, and even we can even look at earnings. UPS had a blowout earnings report. For these both, pricing power is really kind of driving the improved, significantly improved margin. So for me, you have to own both.
Give me a quick name for final trade, please.
Uber, they report this week. If keep going back to the CEO, if Amazon owns next day, they want to own next hour.
Okay. Farmer Jim, final trade.
Viacom CBS. Plus, I put some new books up that are age appropriate for Steve. He didn't like my other books. These are more age appropriate for Steve. Plus, for nap time, he's got Goodnight Moon.
All right, beautiful. All right, Steve, hurry up. Just a name.
Moderna reports Thursday.
The clock was against your comeback. Joe T.
I sold CGen personally and out of the index.
All right, good stuff. Thank you. The exchange starts now.
And Goodnight Moon, that's one of our favorite books around here. Thank you, Scott. Hi, everybody. I'm Kelly Evans. Here's what's ahead this hour. It's been calm, maybe too calm in the market lately. There's been lots of drama with individual stocks, but overall, we've been enjoying a pretty low drama rally. Can that last into the summer months? We'll ask. Plus, shares of Pinterest, Twitter, and Peloton all struggling as investors turn to reopening stocks. But other pandemic plays like Amazon and Google are still performing pretty well. Will Clorox join them on a new higher plateau, or does it face a post-pandemic cliff? And while some enjoy hand-picking meme stocks, others prefer the steadiness and predictability of self-driving money. We're going to speak with the CEO of Wealthfront about the best ways for new investors to play the market as rival Robinhood comes under tough criticism this weekend. But we start with the markets, and Dom Chu is here to kick things off as always. Hi, Dom.
I think our family, my daughter at least, very much a hungry caterpillar type person. So good night, Moon and hungry caterpillar. We're all about kids' books here at CNBC. Anyway, the Dow Industrials up almost 300 points. We were up roughly, call it 346 points at the highs of the day. So we have been tilting higher for the most part for the blue chip index. The S&P 500 up about 1/3 of 1%, just a hair below 4,200 the last trade there. And the NASDAQ composite underperforming off by about 1/2 of 1%, 13,910 the last trade there. A lot more underperformance has been happening in certain parts of the market, specifically today with regard to many of the electric vehicle names. Check out Tesla, Fisker, Nikola Corporation, just some of those names, some negativity around sentiment, some regulatory concerns in key markets around the world, driving some of these types of names. The one I would say is standing out is NIO, the Chinese EV automaker, has managed to eke out a 1/2 of 1% gain. Still, though, watch those electric vehicle makers. And then the stock of the day so far today. Would you believe it if I told you that, yes, Avis Budget Group, the car rental giant, is now higher than it was at any point pre-pandemic? It's also, believe it or not, a record high in trading today. It's off about 1% off the session highs. Still, though, Avis Budget Group catching some tailwinds because people are renting cars more during the pandemic. People will be renting cars more during the summer months as they travel. And guess what? They sell used cars, too. And guess what? Prices have surged. Yes, used cars. Avis Budget, I highlight this, Kelly, because over the last 5 years, up 277%. It's up about 140% on a year-to-date basis. And Kelly, they report earnings after today's closing bell. Back over to you.
That is quite the buildup, Dom. Thank you very much. Markets overall have enjoyed a low-drama stock rally so far this year. The Dow and the S&P are coming off their third straight month of gains, while the NASDAQ and the Russell 2000 have continued their winning streaks from last fall. But is the calm about to give way to a choppier summer? Michael Santoli is here with a closer look.
You know, Kelly, there is certainly precedent for this kind of setup leading to a little bit of a pause or a pullback, but this market has actually refused to do that. That's been the case for a while. I have some context here historically in terms of the June 30th. What I want to draw your attention to is that little bounce, the choppiness, the anxiety around the election. Very orderly uptrend. It really has been pretty unflappable. Now compare it to what we saw from 2012 into 2013. That was another election period, and you'll see same kind of thing. A little bout of anxiety around election time, and then a very, very low drama rally. This continues all the way through to the end of 2013. One of the strongest years in memory. It was up 30%. The S&P finally, the last election before this one, 2016, very similar pattern. Of course, the issues were different. The anxieties were different in detail, but it's had the same kind of market effect. And you'll see this very same low volatility up to now. Can we expect exactly the same kind of rerun, which would imply maybe no net progress over the summer and then a strong finish to the year? Maybe. It's a bull market. It can do anything. But I would point out this has been a much more dramatic pace of increase in the market. So maybe we have a little more payback to give, but the actual rhythm and behavior of the market, Kelly, is not giving you much reason to in the system.
And there's two interesting things about this. One is just, everything that's been going on with game.
That was weird. Something must be going on with CNBC. Went away, came back for a minute, now going away. Either way, I'm going away, guys. Got to sign out early. Got to leave for a meeting. Maybe back this afternoon, depending on how quick I get back and depending on how things go. If I don't get back till 2 or 3, it probably won't come back, but we will see. So if I don't see you guys today, hopefully you had a good day. Well, you know what? Let's do a quick gut check, right? Before we leave. Looks like not a whole lot's changed since the last gut check, man. The Dow and the S&P are steady. NASDAQ is down, but it's been steady for about the last 2 hours. Ethereum still taking off. Down the top, another 13, 33, yeah, 33.10 all-time high just a few minutes ago. Man, it is flowing. Oil is doing really well, so oil-related stuff. Some organic stocks are doing really well today. Dillard's, you can see down there doing really well. I finally sold out our positions with Dillard's, used to break even. Expressing no good. Well, Bed Bath & Beyond is barely up. Happen to be at the number one. It's crazy high. I would actually love for it to go crazy down. That is that's where we're at, guys. So interesting day today. I think really Ethereum is taking the cake. What does it officially say up here? Up 17%. Anyway, I don't hate it. It's will be